Welcome you all to the second session for today. The topic for today's second session is recent changes in the ITR and the common filing considerations. To elaborate on this topic, we have with us CA Shashank Mehta. He will be taking us through the changes in the ITR, also specifically dealing with the revision in the schedules. Then he will also be doing the amendments that are, some of the amendments that are relevant for the filing of assessment year 23-24. Also, the much awaited discussion, that is the e-campaign AIS reporting and the how to reply to those AIS notifications that he will be covering today. To give the formal introduction of the speaker, I would like to invite CA Shashank to the basket meeting.
Thank you, Puri Madam, for giving me this opportunity to introduce our speaker for the second session. Second session, we have with us CA Shashank Mehta. Shashank, if I'm not wrong, I think you are our seasonal speaker, right? And that too on a very important topics, ITR. We are heading towards the ITR filing season, and Shashank Mehta, Chartered Accountant, he is with us. So what is going to cover, it is already been discussed by our convener. So to formally introduce CA Shashank Mehta, he's a qualified chartered accountant and graduate in law. He's practicing CA, and his core area of practice, it is of the income tax litigations, representations, and the advisory. He's also the content writer. He's contributing the articles in the various journals of the ICAI, CTC, Taxman, etc. He's a speaker at a various seminars organized by the ICAI and other professional bodies. He's a regular visiting faculty at the KC Law College, Siddharth Law College, and the coaching institutes of the CA on a various curriculums. So with this brief introductions, we welcome you, CA Shashank Mehta, at our JB Nagar CPA Study Circle on a very important topic. To present the memento, I would like to invite our past convener, CA Seema Mehta, Madam. Okay, sir, now dice is yours.
Very good morning, one and all. First of all, I'd like to express my heartfelt gratitude towards the entire team of JB Nagar Study Circle, who has been consistent enough to give me this prestigious dais to present my thoughts on this topic, that is changes in the ITR from last almost, I think, 3 or 4 years. I'm very much grateful to that. With today's first session, we had toured around certain disputed countries like China, Russia, Ukraine, USA, etc. Now I think it's time to come back to India and also deal with certain due dates which are approaching very soon. My today's session is concerned and focused only on certain changes and amendments which are relevant for filing the ITRs of assessment year 22-23 and certain common issues which are generally faced by professional or even by the taxpayers, by the assessees while filing the return of income. We'll have some interaction session also, absolutely, because this is a compliance-based session. Naturally, there will be practical issues which will be coming up in each case, so for each client, for each assessee. So we'll try to deal, at least to come to a most appropriate, I can say, conclusion. So with this, in the name of Almighty and my parents and gurus, I seek your permission to start with this today's session. First of all, as we have been knowing that in last 2-3 years, I think last 4 years, the government has been very much proactive in at least notifying the ITRs well before time. Earlier, even after the end of that particular financial year, the ITRs were not notified. Last 2-3 years, they have been notified well before time. And this year, surprisingly, even the utilities are out. The filing has already started. People have already filed the return of income. So it is going very smooth. Regarding the applicability of certain specific ITRs to the specific assessees, there is as such no change with respect to the eligibility criteria, or I can say specific ITR applies to what kind of assessees. There is no change as such, except for one small change which we will be dealing. So ITR 1 to 6 has been notified way back in February. ITR 7 also way back in February. If I talk, we'll just run through the eligibility criteria of all the ITRs. ITR 1, most important thing to be remembered is it is applicable only for resident and ordinary resident. If you are R but NOR, then you cannot file ITR 1. Same way, it is applicable only for those assessees who are having one house property. So if you are having a very simple salaried individual, but he's having 2 house property, then also you cannot file ITR 1. That is what needs to be considered, okay, in filing ITR 1. Who are not eligible to file ITR 1, the list is given over here. If you are a director in the company, if you are invested in unlisted equity shares, if it is a case where TDS is deducted under section 194N, or if you have deferred your ESOP, or the last one, which is a new, I can say, non-eligibility criteria given in this particular year, ITR, we'll be discussing in the later part, a very small change. Same way, ITR 2 for individuals and HUF who are not carrying out any business or profession. ITR 3 for all the individuals and HUF who are having business income. ITR 4, our favorite ITR, that is the presumptive taxation. However, in that case also, you have to ensure that the total income in that case should not exceed 50 lakhs. So if it is exceeding 50 lakhs, then you have to file ITR 3, not ITR 4. Same, I can say non-eligibility conditions are there, which are enlisted the same. Like if you are a director in a company, if you are invested in unlisted equity shares, or if you are having deferred ESOP, then you cannot use ITR 4, you have to use ITR 3. ITR 5 generally used for the partnership firms. ITR 6 for companies other than those covered by section 11. And ITR 7 again for all the trust institutions and other categories of charitable institutions which are covered. Just a small brief introduction to all the ITRs. Now, 7th proviso to section 139(1), which was introduced in Finance Act 2019. It requires that even if your total income is less than the basic exemption limit, then also as such, by the main section, you are not covered, you are not liable to file your ITR, but by virtue of this proviso, you are mandatorily required to file that ITR, even though your basic income, total income is less than that basic exemption limit. What is the first criteria? The first criteria is when the assessee deposits an amount or aggregate of the amount exceeding ₹1 crore in one or more current accounts maintained with a banking company or a cooperative bank. So even if your income is less than 2.5 lakhs, but in your current accounts, if there are total deposit, I'm not talking about cash deposits, I'm talking about any deposit. If the entire credit side is exceeding ₹1 crore, then you're required to file your return of income. Same way, if the assessee is incurring any expenditure of an amount or aggregate of an amount exceeding ₹2 lakh for either himself or for any other person for a foreign travel. So if you're expending for yourself or for anyone, be it your relative, be it your friends, be it for anyone, but if you are incurring more than 2 lakh, and even if your income is less than basic exemption limit, then also you are required to file your ITR. Same way, if you have incurred expenditure exceeding rupees 1 lakh for consumption of electricity, so the electricity payments which are made by you are exceeding rupees 1 lakh, then also even though your income may be nil, then also you are required to file your ITR. And there are certain other conditions also, which are notified by notification number 37 of 2022, which was even discussed in the last year's session. The very first one is, if the assessee's total sales turnover from business exceeds rupees 60 lakh, then also that person is required to file ITR, even if his income is less than 2.5 lakh. Here for business, it is 60 lakh. Same way for profession, if the gross receipt is exceeding rupees 10 lakh, then that particular professional is required to file the ITR. Another category is where the TDS and TCS, the body uses and in between. So aggregate of TDS and TCS to your credit is, if it is exceeding rupees 25,000, if you are not senior citizen, then also you are required to file your ITR irrespective of whether your taxable income is there or not. Whereas if you are a senior citizen, then this limit of 25,000 has been enhanced to 50,000 rupees. And the last one again, the deposit in one or more saving bank account of the person in aggregate is rupees 50 lakh or more during the previous year. So this is also one of the important conditions, that irrespective of whether you earn income or not, if in your saving bank account, if the deposits are exceeding rupees 50 lakhs, then you are required to file return of income. In case of certain people, certain individuals, like say for example, any person who is not earning anything, say for example, there's a person who is aged 58 years, he's not working now, his son is working. Now that person as such is not required to file ITR. However, the son is giving his father some maintenance, or he's availing any loan or anything. Say suppose at the age of 58 he's availing any housing loan, and the amount is getting credited to his bank account, his saving bank account, if at all it is coming through that route. And in that case also, even though he has no taxable income, still he is required to file his ITR. Obviously, the total income in that case will be zero, but he will be required to file it, at least report that he is filing this return pursuant to 7th proviso to section 139(1). So that if you start the ITR, the very first page which will appear is under which section you are filing return of income, whether under 139(1) or whether it is in pursuance of 7th proviso to section 139(1). So that is what you are required to report over here. Then I'll be dealing with certain changes. This year, there have been very few changes which are made in the ITR. I have covered those changes over here. The very first change, as I said, regarding the eligibility to file ITR 1. Just a few minutes back, we discussed about the 7th proviso, the very first condition. If at all, in your current bank account, there is a deposit of more than 1 crore, then you are required to file return of income. Up to last year, such kind of person, even though in his current account, if he is receiving more than 1 crore, he was at least allowed to file ITR 1. So maybe he must have discontinued his business, but still he's having a current account, and there are deposits in that current account, maybe of a personal nature or any kind of deposits. Not necessarily that it will be business deposits. Up to last year, such kind of person was eligible to file ITR 1. From this year, they have shut down that window. You cannot file ITR 1, you can file ITR 2. Okay, so that is one of the basic questions, that if there is a current account and there are deposits in that current account, how will you even allow ITR 2? Because if it is a current account, it's generally presumed that there is business. But I think it will cover a scenario where the business is done, current account is there, but still there are deposits which are not related to business in any sense. So maybe for that, at least they have kept that window open for of ITR 2. Absolutely, very much possible, sir. Very much possible. Another change in ITR 5, 6, and 7. In the assessment year 2021, they had introduced this drop down of what are the types of property which are held by that particular assessee, whether it is self-occupied, whether it is deemed let out, or it is let out. So that self-occupied was introduced in assessment year 2021 for the first time. Earlier, it was only 2 categories. I am not able to make out what was the reason for introducing that SOP for companies or for firm, because as per section 23 or as per section 24, for SOP, the ALV will be nil only if the owner occupies that premises for his residential use. Now, a company or a firm cannot reside anywhere. They can have office, they can occupy an office, but they cannot reside. So it was altogether illogical to introduce that particular drop down. So now they have removed that drop down. And even otherwise, what used to happen is, after the introduction of the drop down, people used to report their office premises in that SOP. So I used to select SOP and I used to write my office premises XYZ address, and this is my SOP. So I'm occupying, I'm filing ITR 6 or ITR 5. Now, because this SOP drop down is done away with, I don't think so even that is required now to report. And even otherwise, I'll say, if I talk legally, Section 22 itself prohibits any kind of property which is used for the purpose of business. It will be outside the ambit of Section 22. Once it is outside the ambit of Section 22, there comes no question of classifying it as SOP. Okay, so even legally, it was wrong to say that this particular premises for a company, this particular premises is a SOP. If I talk about Section 22, just a small change. Now there is no drop down to select SOP in case of ITR 5, ITR 6, ITR 7. So yes, definitely, if you are having lot many offices and branches, you are not as such required to report in that house property schedule that what kind of property is that. Because if you are using it for the purpose of business, it is altogether outside the ambit of Section 22 itself. Again, a small change with respect to rate of taxation for dividend taxation, I'll say. Before the abolition of the dividend distribution tax, the dividend income which was earned by a domestic company from other domestic companies, was exempt under Section 10, Clause 34. However, if the domestic company was receiving any kind of dividend from a foreign company, specified foreign company, when the holding is, more than 26%, etc., all these criteria were there. So if the dividend was flowing in from that particular foreign company, then in that case, it was taxable, but it was taxable at a concessional rate of 15%. So there was a specific line item under the schedule IFOS where you have to specify the tax or the amount of dividend which is received by an Indian company from a specified foreign country, which is taxable under Section 115 BBD. Now, after the abolition of the dividend distribution tax, whatever dividend I was receiving from my domestic company was taxed at my slab rate or at the applicable rate. In case of company, it will be that particular applicable rate, 25%, 30%, etc. Now, in order to bring parity for domestic dividend as well as foreign dividend, they have omitted this provision. They have come up, they have rationalized this provision, saying that now no more the concessional rate will be applicable. It will be taxed as per the regular rate, which is applicable to that particular company. So there was a line item given in schedule IFOS, which has now been done away with. It has been removed. I just striked it off in the last part. Additional disclosure for FPIs and FIIs, foreign portfolio investors and foreign institutional investors. You have to mention in your ITR 2, 3, and 5 whether you are a PFI or FII or not. So that is an additional disclosure which is required in this year's ITR. They will ask you your SEBI registration number. That registration number is required to be entered over here. Just a small change. Once you say that yes, you are a FII or FPI, then automatically schedule 112A, that is dealing with long-term capital gains for residents, okay, which is not applicable to FPI and FII, it will be automatically disabled. So this is also just a disclosure, I can say, reporting requirement which has been brought in. Another reporting requirement is regarding the donations which you are claiming as exemption under Section 80G. As we have been seeing in last 2-3 years, there have been several amendments in the taxation of trusts. This is especially to curb all the malpractices which are going on, which are routing through the trust institutions. Now, the even trusts are required to file the statement of donation which they have received in Form 10DB, etc. So now they are linking everything, that whatever statement is received from that particular trust, by XYZ assessee has given this much of donation. All this has been linked with the ITR also now. So in the ITR, if you are given any donation to any institution which is eligible for claiming exemption, you are eligible to claim exemption or deduction under Section 80G. Okay, where 50% deduction is allowed subject to the qualifying limit. In that case, you will have to specify all the details like the PAN of the trust, name of the trust, and even your donation reference number. So this is the new thing. So you have to ensure that whenever you are filing the ITR for your clients which have made such donations, you take that ARN from them, because without ARN, I don't think so they will process that deduction for you or exemption for you in the 143(1). Okay, so you have to give that reference number. There will be a provision, there will be a check of that reference number with the form 10DB also. And accordingly, so they will be matching the data. So ensure that you fill in the correct ARN number of that particular donation receipt. Ma'am, so this is something which the assessee needs to be vigilant about. If you're making donation to a trust, you make sure that you take the receipt and you get that particular number from them. Yes. Yes. According to me, if I talk about compliance of this particular thing, I understand this forms are notified just 2 months back, and this is a new requirement which is coming. It's a practical issue, but I think you will have to go to the trust again and get that number. Practically, yes, practically possible. Absolutely. Correct. Correct. It is a practical issue, but the vigilant one would, again approach. If the amount is big, and obviously if you are claiming the deduction, you will have to approach. You will have to find a way out for that. For your own donation, you may not get that online number. I don't think so. So yes. Yes, please. So in case of a donation to that PAN number is given in the website of PM Care Fund. There is a PAN number which is given over there. There is a FAQ which is providing each of this fund the website, and they have specifically given that what PAN we are using, and that is to be mentioned. I think in my last year's presentation, I had even quoted that PAN, what PAN needs to be given when you're contributing to the PM Care Fund. So that is there on the website. You will get it, sir. Absolutely, 50% with qualifying limit. Yes, yes. No, no. ITR 5, again, some changes with respect to the disclosure which are required to be given in case of change in the constitution of the firm. Okay, whenever there is admission or retirement, you have to give details as to who has been admitted or who has been retired from the firm. 2 additional disclosures are now required to be given. That is a PAN of that particular partner, as well as remuneration which is paid or payable in case of that retiring partner. So if there is a retirement, then you have to provide even the amount of remuneration which is paid or payable to that particular partner. So this is just a new additional disclosure requirement which is there in this year's ITR form. So PAN and the remuneration paid or payable in case of a retiring partner. ITR 3, if I talk about the balance sheet side, earlier there was only one column, that is advances, the borrowings, I can say. Now there is an additional disclosure. You have to classify that entire advance into 2 parts. The advances which are received from a specified person covered by section 40A, subsection 2, clause B. That is your related party transactions. So if you have borrowed any advances or borrowed any loan from those categories of person, that has to be reported separately. And from other persons, you have to report it separately. I think this kind of details will help the assessing officer at the time of assessment to check whether there is, the reasonable payment of interest or not, whether the rate of interest which you are paying on that particular borrowings, whether it is not beyond, reasonableness. So that is, I think that would be the utility of this particular disclosure, additional disclosure. It is already there in ITR 5 and ITR 6, this kind of bifurcation. It was not there in ITR 3, now they have provided. Again, a sunset clause for which this schedule has been removed for certain categories of transaction. So up to 31st of March 2012, deduction was allowed to certain kind of undertakings which had set up their operations in Jammu and Kashmir. Up to 31st of March 2012, if they had started with their production or operations, then for 10 years, they were allowed this particular deduction. Now that 10 years has already expired on 31st of March 2022. So that line item in section schedule 80IB of claiming deduction for Jammu and Kashmir territory, or setting up that plant in Jammu and Kashmir territory, has been done away with. They have removed that particular line item from schedule 80IB. Facility to transfer TCS credit. This is also an important change and I can say welcoming change. We all are aware since last 4 years, they have provided a very elaborative schedule for TDS and the transfer of credit of TDS. So if it is of your own TDS, then how will you bifurcate whether it is, even though it might have been deducted in your own hands, but it may pertain to some other person. Then the ITR will ask details of the PAN of that particular person, what is the amount, whether it is a brought forward credit, what is the amount of credit which you are going to carry forward, or there can be a reverse scenario where the TDS has been deducted in the name of some other person, however it relates to you. So now that person will be transferring that credit to you. So in that TDS schedule also, you are allowed to report the figure which is coming from other person's 26 years. So you have to mention the PAN number. You have to mention what is the amount which you are claiming in your own hands, but it is reported in 26 years of some other person. So such kind of facility was not there in case of TCS. Okay. So now in this year's ITR, they have introduced this particular schedule, that is schedule TCS was already there, but these line items have been introduced so that, this particular TCS can be bifurcated in case of, joint deduction which is made. Now we come to relief under section 89A. I'll explain this particular provision which was introduced in the last budget with the help of an example. Yes, please, sir. Yes, sir. Yes, sir. Correct. If the category is okay. Sir, in case of TDS, if you're talking about TDS, if you go to the portal, say after receiving 143.1, there is a mismatch. They have not given you that credit. That is a question, sir? Okay. Now, if you go to log into your portal, if you go onto the services tab, service tab in the income tax portal, service tab, you will find one line item tax credit mismatch. Okay, so in that tax credit mismatch, they will report all the items which they have disallowed in 143.1. Yes. According to me, in that particular reply, you should give the correct details as to how that credit pertains to you. Yes. According to me, that should generally resolve your query. But it is not. Then, sir, the only option is either you can go for rectification or you can go for appeal. JAO will not do anything like always. As usual, yes. So this TCS also now you can bifurcate it properly and you can, if the other person is there in whose hands this TCS is to be claimed, then that can be done. Sir, this will be a bit a task, I'd say. They will, in return of income, you can definitely fill whatever you want to. But while processing, they may raise this query because that person needs to enter the details कि उन्होंने अपने हाथ में कितना claim किया है और उन्होंने दूसरे के नाम पे कितना रखा है. So if, say, suppose in your hands, the entire TCS has been, deducted or credited. Now, in your schedule, you will have to report that out of, say, rupees 1,50,000 belongs to me and 50,000 belongs to my wife or some other person. And you have to mention the PAN. So I think there has to be matching between these two things. In 143.1, if you are not reporting, then definitely it will be getting disallowed. However, again, there are remedies to it which you can approach. Ensure that at least that person reports it properly. It is as simple as that GST mismatch credit. Okay, section 89A, a beneficial provision which was brought in the last budget. For the non-resident who were non-resident earlier but now are settled in India. I'll explain this with help of an example. Say, for example, last 4 years, I am in India. I am a resident in India. Last 4 years. Before that, I was a resident of Canada, for example, Canada. Now, I was employed over there in Canada and I had a retirement benefit account in that particular country. Now, that account can be, the amount can be withdrawn from that account only after a span of 15 years or 10 or what, in a future longer date. And only upon withdrawal, I will be required to pay tax in Canada at the time of withdrawal. So I have left Canada since years. My account is already there. Now what happens is, as per that tax laws, this amount will be taxable, say after 10 years in that country. But in India, because now I am resident in India, my global income is taxable, and every year I am earning some interest in that particular account, which is accrued. It is not received by me, but it is accrued. So naturally, even if it is accrued, then I have to pay tax on it. So what was happening was, I was paying tax on an income which was not even credited to my account. And second most important thing is, after 10 years, I will be paying tax in Canada on the entire amount, even though I can get the credit of the tax paid after 10 years. But what I will do with that credit? Because in this span of 10 years in India, I have already paid the tax from my own pocket. I have got no credit for that. And after 10 years, they will give a lump sum credit of that amount in the 10th year. What would I do with that credit? So this was a practical issue which was faced by certain non-resident who had settled back to India. Okay, but they were having certain accounts, benefit account, employee benefit account in those countries. Okay, so in order to align this point of taxation, or I can say year of taxation, they have introduced this particular section providing that particular assessee can choose in which year he wants to get his interest or that amount taxed. So there is a particular form which is required to be filed, that is form 10EE. Okay, this form is required to be filed, and in that form you have to report that you wish to tax this amount, or you wish to offer to tax this particular amount upon withdrawal of that amount from that foreign country. In that year you will pay tax. So what in this schedule, the entire new schedule has been brought in. In this schedule, what you have to report is, first of all, you have to specify whether that retirement benefit account is in a specified country or a non-specified country. So there are two categories of that. Only if it is from a specified country, then this section can help you, otherwise not. So presently there are 3 specified countries, that is Canada, UK and USA. These 3 countries are there in the drop-down. Apart from that, you have to then again you have to report that what is the amount which has been accrued. So you have to include in your IFOS. It's not that you have to not report. No, you have to report it. You have to specify that in the IFOS schedule. And after that, you will also get that field like that out of that amount, what is the amount you are going to defer, or what is the amount you are going to claim deduction as of now in this year, but you will pay tax later in the year in which that amount will be withdrawn. However, once you report that amount in this particular column, that is income claimed for relief from taxation under section 89A, they will give you a pop-up that please file or submit your form 10EE before filing the return of income, before the due date of filing the return of income. Same way, in this schedule itself, there is one more line item at the bottom, that is, I think, Roman number 4, wherein you are required to specify that if in earlier years you have claimed the deferment, and this year that amount has been withdrawn from Canada, and this year it is taxable in Canada, and then you have to report that yes, this year earlier I deferred it, now I am offering it to taxation. So this is also a new line item which has been brought in the ITR section 89A. Taxability of VDA, that is virtual digital asset, commonly known as cryptocurrency. There was a huge balloon, or I can say hype in the last 2 years. What will be the taxation of this, that? Everything I think is now on a nosedive. अभी इतना कोई बात करता नहीं इसके बारे में, ना किसको इसके अंदर जाना है. But yes, definitely taxation is very important. So there is a definition given of what is VDA, that is virtual digital asset, under clause 47A of section 2. It inter alia covers this cryptocurrency. In short, it covers anything which does not have any underlying, but it is just based on any promise. That's it. Okay. So it is any kind of, I cannot even say it asset, though legally it is an asset, but it is something which we cannot see, which cannot feel anything, but it is something which has no underlying. That's it. So cryptocurrencies, NFTs, or any kind of digital asset, all these are covered by the definition of section 247A, that is VDA. Now, there are certain categories which the CBDT has excluded, which will not be considered as VDA, even though otherwise they may fall in the definition of VDA. So this is the notification number 74. The very first one is gift card or vouchers. Second is mileage points, reward points or loyalty cards. Subscriptions to website or platform or applications. So these three as such may fall under that complex definition which is given for VDA. However, the government or the CBDT has excluded that no, this will not be covered by the taxation of VDA. Another notification was with respect to NFTs, that is non-fungible tokens. In this, they had provided that if your VDA or the NFT is ultimately resulting into transfer of the underlying asset and which is legally enforceable, if that is happening, then also it will not be considered as regular VDA or regular NFT for which this taxation provisions are applicable. Okay, so if there is a proper transfer of the underlying asset which is legally enforceable, then not to worry, it will not be covered by the definition of the VDA. Now, just a brief revision of what is section 115 BBH, that is taxability of the virtual digital asset. It will be taxed at a flat rate of 30%. Deduction will be allowed only for the cost of acquisition, nothing else. Expenditure, allowances, losses of other ads cannot be set off against this kind of income. There will be like operational cost, like cost of mining and other incidental cost, but even those will not be allowed to claim as deduction. Even your basic exemption limit cannot be availed against this kind of income. Say, for example, you have income from cryptocurrency of 2,60,000, and that is the only income you are having, nothing else. Still, that entire 2,60,000 will be taxed at 30%. You will not get the benefit of the basic exemption limit. Loss in crypto neither can be set off against any income nor can be carried forward to subsequent years. You cannot do anything with that. Now, this particular provisions are irrespective of whether you treat it as your business income or a capital gains. It has nothing to do with that. This is specific, code in itself. Section 115 BBH is a taxability. Irrespective if you categorize it as a business income, capital gains, whatever, only this particular scheme is required to be followed. Government are very reluctant to give any kind of benefit to this. Absolutely, absolutely. So now a very important part in this particular slide, very important part. What I have observed is, if I take an example, say for example, I have three types of cryptocurrencies. In two, there is profit of 1 lakh, and in other there is a profit of 1.5 lakh. So that comes to 2.5 lakh. And in the third one, I have loss of, say, again 1.5 lakh. So overall, if I see, I have profit of only 1 lakh. If I talk about the entire cryptocurrency segment. However, as per the provisions of the Act, as well as per the provisions, or I can see the field item which they have given in the ITR, you will have to exclude any script, any crypto where there is loss. So now, in my example, the entire 2.5 lakhs will be taxed at the rate of 30%. But the loss of 1.5 lakh has to be foregone, it has to be withdrawn. You cannot do anything about it. There can be no intra-head, there can be no inter-head, there can be no carry forward. Nothing can be done about it. Even within the same script. Say for example, I'm coming to a next level now. I'm saying I'm having only one type of crypto. One type of crypto. One I have acquired in the month of, say, suppose May, other in the month of August, and third in the month of December. In the March month, I have sold all three of them. Same to same script, same to same crypto. In this case, obviously for all three of them, I'll have some different profit and loss. Even in this case, they are saying you have to report your date of acquisition and your cost of acquisition, date of sale and the purchase cost and the sale cost. And they will automatically exclude all those transactions, independent transactions, wherever you are incurred losses. So it will be automatically reported zero. Once your cost exceeds your sale value, it will be automatically considered as zero. Only the profit figure will remain in this particular schedule. If I show you the schedule, this is the schedule. I can categorize it as my capital gain. I can categorize it as my business income. It does not make any difference. In the first line item, if you can see, the sale value is 25 lakh. The cost of acquisition is 15 lakh. The gain is 10 lakh. 10 lakh subject to 30% of tax. In the second line item, my cost of acquisition is 5 lakh, my sale value is 3 lakh. There is a loss of 2 lakh. But for the purpose of this schedule, it will be considered as 0. Okay, so this is one of the things which needs to be taken into consideration before consulting the client. ऐसा नहीं है कि भाई एक ही स्क्रिप्ट में मैंने 3 डेट पे सेल किया तो उसको नेट ऑफ करेंगे, नहीं कर सकते. You have to report each and every transaction which we used to report in case of 112A when the grandfathering had come. For every script wise reporting was done and date wise. Here also date wise reporting is required to be done. So this is going to be a TDS task if there are multiple transactions, which has been taken place by that particular assessee. It is very difficult to explain the client because client will say, "Bhai, मेरे जेब में तो से 1 लाख रुपया है." It's very difficult to explain them कि नहीं ऐसा नहीं है. Then they will blame the government. ऐसा है. Sorry, sir. Sir, to address your query, there is no direct provision in the Act or in any notification circular for this VDA. But yes, as you said, in 2016, we had stability circular dealing with shares and securities, wherein they are allowed that assessee can adopt FIFO method. But if you are able to correlate each and every transaction, whatever is beneficial to you, I think you should go with that. Yes, please, sir. No, absolutely not. Sir, these are all alternate remedies. You can file whatever you want into ITR. You cannot even try to fill up the schedule. You can go and directly enter into capital gain schedule. That is what people used to do. Okay, कि ठीक है इतना सारा मैं किधर लिखूं एक जगह पे डाल देता हूँ query आएगा तब एड्रेस करूंगा. So that all means are available to you. But what is required by the ITR is this. Now, disclosure of intraday, again a very interesting topic. Whenever intraday sort of shares and capital market comes into picture. Speculation transactions are defined under clause 5 of section 43. Again, the definition says that whenever you're dealing any kind of securities which has no underlying to it, it will be considered a speculative transaction. However, there is an exception saying that if you're dealing in derivatives which are dealt in a recognized stock exchange, then it will not be considered as speculative. Even though as such they are speculative, but for the purpose of Income Tax Act, they will not be considered as speculative transaction. The formalized derivative transaction, option trading, future trading, etc. Now, if I talk about intraday transaction are not covered by the exceptions. And these are transactions where there are no underlying. You buy in the same day, you sell in the same day, and you incur either profit or loss. ICI had in their guidelines of 2014, para 5.14, they have stated that how to calculate the turnover for this particular segment. That was only for, I can say recognizing the limit of turnover when it comes to tax audit, the threshold limit. In that, they have stated that what you can do is take the modulus of all the negatives and positives. So you may incur like many transactions in a particular day. Actually, if you see the sale value, it may go into crores and crores and crores. But actual only the net difference is the amount which is considered as turnover. So there can be a negative as well as positive on the same day. So say for example, in a buy-sell transaction, for one transaction, there is, I can say positive 1,000 rupees. And for a buy-sell transaction, second transaction, the same day, there is negative 500 rupees. So as such, in your pocket, your profit is 500 rupees. But in this case, as per the ICI guidelines, the turnover is 1,500 rupees. So this is how you have to determine your turnover for the purpose of applicability of section 44AB. Now, in this year's ITR, they have provided a reporting schedule, a disclosure schedule as to from the entire trading account, whatever gross profit you are having. In that gross profit, what is the element of your intraday profit or loss and what is the turnover there? So this is not a separate schedule which is going to get reflected in your, I can say P&L account. This is below the line item. After your gross profit, you have to bifurcate that in this gross profit, what is the element of your intraday profit and loss and what is the turnover there. Now, in this case, I don't know how they have structured the ITR. It is very much possible that the turnover which you have reported in your trading account may be less than the turnover which you derive for the purpose of this kind of intraday transaction following the ICI guidelines. It is very much possible because as per ICI guidelines, you have to take the modulus. This kind of modulus is only for determining whether the tax audit limit is applicable or not, whether the limit is getting breached or not. You cannot say that this is your actual turnover. No, it's a derived turnover through that particular guidelines. How can I say that 1,500 is my turnover? No. Okay, so yes, now while reporting, it is possible that your actual turnover will be less than the derived turnover which you are disclosing in that intraday schedule. I hope they will understand that this possibility is there. But yes, again, it is nothing like this is a new schedule where from which the figures will be reflected ahead. No, it is just a bifurcation. So that is intraday transaction disclosure. Now again, 115 BAC, a topic of every year's opt-in, opt-out. I don't know why they are playing Garba in this unnecessarily. They have even come out with a new form for the next year now. I don't know what is the utility of that form. We'll be discussing maybe in the next year's ITR. So now, this particular schedule was already there up to last year. They have elaborated this schedule. That is section 115 BAC alternative regime for individuals taxation. If at all you are an individual and you want to opt in for the alternative regime, but you are carrying on in a business or a profession, there was a proviso which says that once you opt in, you can opt out only one time. After opting out, you cannot again opt in for that. So in relation to all these details, they have come up with a detailed schedule now. Up to last year, it was a small schedule. Now there is a detailed schedule. It will first ask you whether you opted for 115 BAC in earlier years or not. If you say yes, then you have to give the details of your filing of Form 10E as well as assessment year in which you have opted in, what was the acknowledgement number. If you say no, I had not opted earlier years, then this will be disabled. And then in the second line item, they will ask you whether you want to opt in, opt out, or whether you want to opt in or not in the last third line item. Whereas if you say I had already opted, then there will be a new category of reporting, that is the second part which I have highlighted, wherein they will ask you whether you have opted out in earlier years or not. Okay, so opt-in किया था कभी भी पहले, you have to report कि कौन से साल में आपने opt-in किया था. Now second line item will ask you whether after opting in, whether in any previous year you have opted out. If you say yes, then they will again ask you details. Once you say yes to that, automatically all the details which are there in the bottom that you want to continue to opt in, that you want to opt in will be disabled. Only one option will be there, that is not eligible to opt in. Okay, so that is the last item which I have, which is after the highlighted part. That once you say that you already opted out, it will automatically display that you are not eligible to opt in. So all these permutation combinations are there, which they have enlisted in this particular schedule. This is a small change again. Now, very important. This instruction are not mine. These are verbatim dicta of what is given in the instructions to the ITRs. So every year the CBDT comes up also with the instruction module, which runs into 300-500 pages. In this instructions, they have given certain instruction with respect to 115 BAC. Now, very first note is option for new tax regime will be available only till section 139(1). Obviously, if you want to opt in for this, you have to file return of income before time or on time, and say, and also you have to report that in Form 10I. Second note, very important. Taxpayer can opt in or withdraw from the new regime under section 115 BAC in revised return if it is filed within the due date as per section 131. Now, I'll have some legal touch to this. This particular instruction permits me to change my category, to revise my category in the revised return. Say, पहले मैंने opt in किया, now in the revised return I'm opting out. और मैंने opt out किया था, now in the revised return I'm opting, which is not possible because 10I file नहीं हुआ रहेगा. But first case is possible. मैंने already opt in किया है, regular return भरा है in the new scheme. Now I am opting out by way of a revised return. This instruction module says it is allowed. But we had a recent Supreme Court judgment, the case of PCIT versus Wipro Limited. there is a specific observation of this Honorable Supreme Court in para 12 of the judgment, saying that the revised return are only for omission or any mistake. You cannot shift your category from one scheme to other scheme by virtue of revised return. So in that case, that particular assessee earlier had obtained to claim tax exemption under section 10B, that is for ITR enabled services. However, after some point of time, they realized that we are having losses. So this exemption will not help us. Let us carry forward that losses. Let us file a revised return. Will not claim any kind of exemption at 10B because we are not having any profit. But what we'll do is losses jo hai usko carry forward karenge. So this matter traveled back to the Supreme Court. Supreme Court said no, your revised return is only for mistakes and omission. You cannot just change your scheme for that. Now this guidelines of CBDT, according to me, if I am an officer, assessing officer, I will say that these are contradictory to Supreme Court judgment. Now, say suppose, for example, this thing happens practically, that you revise your return, you go opt out automatically in the old scheme. From new scheme, you are going to old scheme in the revised return. Officer says, no, you cannot do this by virtue of Supreme Court judgment. I will say, ki aapne to instruction mein diya tha. They will say, no, Supreme Court judgment will, prevail. My argument as a counsel will be, the department is covered by the doctrine of promissory estoppel. As per the doctrine of promissory estoppel, once the department has put in something on the public domain, which they have specifically stated this will be allowed, now you cannot snatch that benefit again from the assessee. So if this matter travels like in upper forum, this will be my argument as such. But yes, just a legal touch to this discussion, just to make it a little bit interesting. That's it. ITR 7, there are few, I can say many amendments. I have covered certain relevant amendments which are applicable. ITR 7, if I talk about, there was a amendment which was made in Finance Act 22 with respect to 22nd proviso to section 1023C, that is applicable to specified educational institution, hospitals, etc. In that case, we all know that there are certain conditions, basic conditions which are required to be complied, that you have to maintain your proper books of account, you have to file a return of income on time, and you also have to furnish certain kind of reports within that particular time. If you're not doing that, then automatically that exemption will be disallowed. That exemption, you cannot claim those exemptions. Now, in order to specify what all disallowances will be made, this particular proviso was inserted, 22nd proviso to section 1023C. These are the list of items which are given under that particular schedule. And in the ITR also, under Schedule TI Part B3, they have enlisted all these line items wherein the figures will be auto-populated from the other fields of the ITR as to what all disallowances are now made to your income and expenditure account on account of disallowance of this particular exemption. So expenditure from any corpus standing into the creditable trust as on the end of the financial year will be disallowed. So corpus में से आपने जो भी expenditure किया रहेगा, that will not be allowed in your regular computation. You, in short, you will be covered by the regular computation of the ITR. Expenditure which you have made from any loans or borrowings, okay, which as such are considered as application, will not be considered now. Okay, so that you cannot claim that as your deductions if you're expending it from your loans and borrowings. Depreciation in respect of any asset acquisition of which has been claimed as application of income. Okay, so if you are acquiring an asset that was considered as application of income, such kind of deduction also will not be allowed once you are into, once you violate all those conditions of not filing ITR or tax audit report, etc. Expenditure in the form of contribution donation to any other person. So if you're applying your own funds in making donation to any other person, that also will not be allowed. Disallowance will be made also under section 40 clause A, subclause 1A. Okay, that is non-compliance of TDS. This is going to be very harsh because as on the date when you are making such kind of payments, you are making in a good faith. I assume you're making it in a good faith that yes, this is going for this particular donation. Just because at the time of ITR you filed that ITR late, entire thing will be gone. And now, if you have made that particular payment which is otherwise subject to any kind of TDS provisions, then even that amount will not be allowed to you. Any kind of expenditure. Same way disallowance under 40A3, that is cash payments made. No deduction will be allowed for the expenditure not incurred in India. So if you're made in donation or any kind of expenditure outside India, it will also not be allowed. So this is that particular new schedule which has been introduced in the ITR 7. Okay, most of the figures will be auto-populated from other fields. Additional details, very small change in details of author, founder, trustees. Earlier, you had to report the details of all the author, founder, trustees, manager as on the date of that particular application, whenever you made the application for the registration of the trust. Now they have changed it as at the end of the year. So, us saal mein, any point of time, whosoever are the trustees, authors, managers, etc., details, personal details of all those dignitaries is required to be given. Very small change. Schedule IA again, as we all know that in case of trust, up to 15% is allowed to be kept as reserve. So if you're receiving 100 rupees donation and you're applying only 85 rupees, that is fine. That 15% will not be considered as your income. It's fine. However, if you wish that, no, I want to reserve more for the future years, you're not expending 85, you're expending only 70, and you're reserving 30 rupees. Then in that case, it is allowed subject to certain specific conditions. Now, say for example, you are not complying that particular condition in the forthcoming years. So there is a condition of 5 years, 1 year, etc. Things are there. In the future years, you are required to expend it, but you are not expending it, or you are expending it in a manner which is not allowed, otherwise allowed by the Act. So there is a violation. Now, up to last year, there was no such requirement wherein you are required to report your past history about your accumulation and the violation of such kind of accumulation. There was no such schedule. In this year schedule, they have provided that last 5 years का आपने जितना भी accumulate किया है, उसका कौन सा figure है, and corresponding to that, you have to also report that in which all year you have kind of violated that accumulation का जो conditions है, by virtue of which it was already taxed in any previous year. So this is just, I can say, means of gathering the data. Okay, accumulating the data कि भाई इतना accumulation है तो कभी कितना apply किया, because at the time of assessment it becomes very difficult to categorize everything. कभी कौन सा आया, कभी apply किया, कभी नहीं किया, कभी violation हुआ. So if this is in the ITR schedule itself, I think it will be very simplified at the time of assessment. So again, a new reporting in schedule IA. Schedule balance sheet, and that is schedule BS. Again, a new breakup has been given. In this breakup, regarding the corpus donation, regarding the balance sheet application of the fund, that is on asset side, you have to divide it into 2 parts. So obviously your entire asset side is freezed. After that, you have to categorize it. So out of the total application, what are the applications which are made under section 11, subsection 5, that is the specified mode of investment, and what are the applications which are made otherwise than that. Okay, so this is also one of the reporting criteria. Proper accountancy can only help in reporting all these kind of requirements which are now required under trust. Okay, so out of the total balance sheet, you have to bifurcate into 2 parts. Make sure that your clients does it before time, because it may take a lot of time to categorize, especially in case of huge trust. Schedule R, again a new schedule. It's a reconciliation given between the corpus donation which is reported in your balance sheet and the corpus which is reported in Schedule J. Schedule J is a specific schedule for reporting all kind of investment which are made under 11.5 relating to your corpus. So out of corpus, whatever investment you are made in 11.5 specified modes, you have to report it in that particular schedule. Now, this particular schedule R, you have to fill in and you have to reconcile the difference between the corpus which is reporting in Schedule BS and the corpus which is coming in the Schedule J. Okay, so the reconciliation will be on account, generally on account of this purchase of fixed asset and the depreciation thereof. Because in Schedule J, that may not be included, or in balance sheet, you will have that particular line item of your fixed asset. So they have also given a residuary line wherein for any other item which is not covered by these 2 categories can also be filled up. But again, this reconciliation is there. It may be time consuming if the accounts are not properly maintained. So again, it may consume a lot of time while filing the return of income. So to my understanding, these were the, I can say, few relevant changes in the form per se. I'll say the changes which are made in the form itself. Now we'll be considering certain amendments which are relevant while filing the return of income for assessment year 23-24. This amendment pertains to Finance Act 23 as well as Finance Act 22.
I have covered certain important amendments. Very first one is made in Finance Act 2023 itself, which is even applicable for assessment year 23-24. That is Agnipath scheme, contribution to the Agnipath scheme. Now, what is this scheme? We all know that this scheme has been brought up to encourage the youth of India to go into the armed forces. Now, in this scheme, they have stated that we will open a fund, that is Agnipath scheme or Agnipath fund, Agnivir Corpus fund. In this particular fund, the eligible person who has enrolled for that particular category, okay, he has the option to put in some amount out of his own pocket. Plus, the government will also contribute in that particular fund. That is nothing but the stipend, or I can say the payment which the government will give to that particular individual who is, serving the country. So now, actually, as per section 17, subsection 1, clause 9, the contribution which is made by the government to these funds is considered as salary. Okay, it is considered as salary. It is your salary. It is covered within the definition of salary. Simple. However, section 80CC provides that whatever contribution is made by the central government to this account will be allowed as deduction. Okay, so this particular deduction was introduced in this Finance Act 2023 itself. Now, again, there are two categories. Say, suppose if the individual has opted for the scheme of 115 EAC. So, if you are in the new regime, then under this particular section, you will get deduction only to the extent of the amount which is contributed by the central government. So, central government ने आपको जो salary दिया है, okay, the stipend दिया है, that will be allowed as deduction. That is required to be reduced from your taxable income in the new scheme. However, in the old scheme, if you are sticking to your old scheme, then whatever voluntary contribution that particular individual makes to that particular fund, that is also allowed as deduction, as well as the amount of contribution which is made by the central government to that particular account of that particular individual, both will be allowed as deduction. So this is also one line of item which needs to be considered when you are filing return of income for such kind of individuals. That is a section 80CC. Section 68 as such not relevant for return filing, but I will say from the stage of return filing itself, you need to consider that in the last budget we had this amendment in section 68 which says that if you are borrowing any unsecured loans, then it will be deemed to be not satisfactorily explained unless that lender also explains the source of that particular funds. So now whenever you're reporting anything in your ITR as unsecured loans or borrowings, make sure that such details will be triggered in section 16 also. You have at least at this stage itself, because assessment comes after 1 year, 2 year, 3 year, फिर वो time पे confirmation नहीं मिलता, ये नहीं मिलता, वो नहीं मिलता, ऐसा सब होता है. So better that in this year itself, before filing return of income, you make sure that you take all these details from the lender so that you don't face any issue when it comes to the assessment stage. Section 68, nothing to do with ITR, but is relevant for filing ITR. Then again, a small change in dividend and bonus stripping, I can say, amendments. This was also made last year. Section 94, subsection 7 deals with dividend stripping. So in this case, if you are acquiring any shares or securities, okay, before a record date, before the dividend is declared, before a specified period, 3 months, etc. And after that record date, you are immediately selling it off and the price goes down and you incur losses. In such cases, the loss which you have incurred will not be allowed. This is the concept of dividend stripping. That was applicable to shares as well as units, mutual fund as well as. There is similar concept of bonus stripping, that is under subsection 8 of section 94. It also says that before the record date, if you are acquiring bonus shares, and after the record date, you are selling it off and you are incurring losses, then that losses will not be allowed. However, this subsection 8 was applicable only for units, that is your mutual fund units. It was not applicable to shares. Now, by Finance Act 2022, they have made it applicable even for all kind of shares and securities. So in this year's ITR, whenever you're filing a return of income, if you're incurring any short-term loss, which is near about being covered by this particular provision, then that loss will not be allowed legally. I don't know in how assessment age, definitely you can take your stand, but as per the law, it will not be allowed. So this bonus tripping transaction is also now made available for. It is also made applicable even in respect of REITs, InvITs, and AIFs. So earlier it was not applicable to these categories. Now, because of the substantial investments and transactions, these categories of investment also, it has been made even applicable to REITs, InvITs, and AIF. So this is also one of the provisions which needs to be considered by filing the ITR. Section 43B, that is deduction will be allowed only when you make the actual payment of that particular line items which are given specified transactions that are given under section 43B. Section 43B has 3 clauses which deals only with interest from loans and borrowings. So if you have borrowed interest from any public financial institution, any banks, even a cooperating bank and PFCs, that interest expenditure will be allowed as deduction only if you actually pay the and it will not be allowed on an accrual basis. In certain cases, what was happening was that people used to convert that entire loan or entire accumulated interest which was due into debentures. So that was converted from loan to debentures, including that accumulated interest. So there were decisions of honorable tribunals wherein this kind of conversion was treated as discharging of actual liability of interest. And hence, it was stated that whenever the loan is converted into debenture, dischargement of the interest liability, and accordingly, such kind of conversion is also covered by, it is not covered by section 43B. It will be considered as if you paid that interest, and hence that deduction was allowed. In the last budget, they have made an amendment in explanation to all of these clauses. In this explanation, they have stated that any kind of conversion from loan to debenture or from borrowing to debenture, including the interest thereon, will not be considered as dischargement of that particular liability. It will still continue as if you have not discharged that liability. So that is also one thing. Now practical issue will come. Then at what point of time I'll get the deduction? That is a very big question. Because once you say, suppose you convert it into debenture, it is possible that after 8 years, the debenture is getting redeemed. At that point of time, maybe you can claim. But up to that period, you will have to wait. So that is also one of the points which needs to be considered by the ITR, especially when there's a conversion of loan into debentures. Tax relief in case of certain categories of individuals whose dependents are, I can say, specially abled. I'll just give this particular provision with the help of an example. Section 80DD provides for a straight standard deduction of 75,000 rupees in cases of those assessees or parents or guardians whose dependents are specially able. In such cases, they get 75,000 direct deduction. The conditions where they expend something for their medical treatment or for future maintenance. Say, for example, there is a father who is now aged. He knows that my son is specially able. He will not be able to look after himself. So what he is doing is, throughout his lifetime, he is contributing some amount to that particular fund, which is operated by LIC or other insurance companies. And this LICs and other insurance company make sure that after the death of that particular father, this particular fund will be used for the maintenance of the particular specially able children. Now, up to last year, there was only one category, which is that only upon the death of that particular parent or that guardian, this amount will be allowed, to be paid to this particular individual for their maintenance, which is allowed as deduction, only that category. So genuine hardship were faced in categories where the parents were senior citizens, they were no longer contributing to that fund, but now they themselves are in need of the money to take care of the child. Fund is there, but they are alive and deduction will not be allowed because they are alive. It was that scenario. So in order to curb this kind of hardship, they have introduced this new provision saying that once that parent attains the age of 80 and he has stopped contributing to that fund, then also that particular parent will get deduction of that 75,000 rupees, even if he is alive, he or she is alive, and they are not contributing to that particular fund. So this is the beneficial provision. Okay, so earlier it was not allowed, now it is allowed, which is still needs to be taken into consideration. Section 79A, again, this was even discussed in last year's presentation. I'm covering it again because this is also one of the important things which needs to be considered when it comes to setting up of losses. So if I take a practical example of this particular scenario, Section 115BBE provides for taxation in case where income is added under Section 68 to 69D. There is special category of incomes. This particular Section 115BBE also provides at the end that you will not get deduction, you will not get any kind of setting off of losses against this kind of income which is added to your total income. You will not get any kind of setting off, or you cannot set off any current year losses also to that. So that was fine, that was clear. However, there were scenarios where, say for example, I am a jeweler, I have a jewelry shop. There is a search in my premises. In that search, I voluntarily disclose that I have unaccounted bullions, I have unaccounted stock of say rupees 1 crore. This is my unaccounted stock. And this is my business stock. Now, in assessment time, the assessing officer used to add this particular bullions into 69A or 69, whatever is applicable. This was made the addition and it was taxed as 115BBE. Now, at this tribunal stage or at the High Court stage, the courts used to held that once the assessee is saying that it is from business sources and he has that proof that yes, it is his business, then you cannot tax it under Section 68 to 69D. You have to tax it as your business income under Section 28. You cannot tax it under 115BBE. So that was removed from Section 68 or 69D up to 69D, and then it was taxed under Section 28. Now, at this point of time, what used to happen? Addition hoga under Section 28, that is fine. But under Section 28, that is under PGBP, it is possible that that assessee has incurred losses in the current year or he has brought forward losses. So now what was happening was people were using these brought forward losses or current year losses to set off that income which is added, that undisclosed income which was added to their income. So this was the kind of loophole in the law which allowed the mischievous taxpayer to set off their undisclosed income against their business profits. To plug in this particular loophole, this particular section was introduced, Section 79A, which says that once it is an undisclosed income which is pursuant to any kind of search or seizure or requisition, at that point of time it is undisclosed, then you cannot set off your existing losses or existing business loss, any kind of loss, brought forward losses against this kind of income. Okay, so earlier these tactics were used, okay, to report in the ITR, but now you cannot use this tactic in the ITR because of Section 79A. Again, Section 14A, a dispute of every year's assessment. They have made it clear now that even if you are not earning any kind of exempt income, but if you are incurred any expenditure in earning that exempt income, then it will be disallowed under Section 14A. Okay, so they have made a clarificatory amendment. So in this year ITR, also you will have to take care in case of client where earlier you used to take a stand that because there is no exempt income by virtue of various decisions of tribunals and High Court, people were taking stand that no, because there is no exempt income, there will be no disallowance under 14A. But now onwards, you have to see to it in your ITR. Even if there is no exempt income, still if there is an expenditure which is incurred, then you will have to disallow that expenditure. There is a Delhi High Court decision on this, I think in the year 2022, September 22, which says that this particular amendment is not retrospective. So I'm not talking about this year's ITR, but just in case Aage assessment data for any future previous year ITR, because this amendment is introduced in the way of a clarification. So they will say because it's a clarificatory amendment, it will apply retrospectively. Delhi High Court has said no, it cannot apply retrospectively, even though the wordings are like clarificatory in nature. Taxability of interest on Provident Fund. This was even discussed in last year's ITR. Again, because it's a new thing, I have kept it as it is in this year's ITR also, this slide also. So generally, earlier, we had that impression that any kind of interest which is earned out of any Provident Fund, it will be exempt under Section 10, clause 11 or clause 12, depending on the category of the particular fund, employee provident fund or the public provident fund. Now, from last year, they have categorized that the interest will be exempt only up to specified limit of investment. If you are investing more than that particular specified limit, then whatever interest you earn on that incremental investment will be taxed under IFRS. So they have categorized this aspect into two parts. One is a fund where even the employer is contributing, and other is the fund where only individual or the assessee is contributing. So in case where employer is also contributing, in such cases, along with the employee, the interest which is earned up to rupees 2,50,000 from the employee's contribution will be continued to remain exempt. However, if the employee is investing more than 2.5 lakh, then on the incremental amount, whatever interest is accrued, that interest will be taxable under IFRS. Same way, say suppose there is no contribution made by the employer, only I am contributing by myself, be it a PPF or be it any other fund, recognized fund. In that case, the limit is 5 lakh. So up to 5 lakh, if I am investing and whatever interest I am earning, it will be exempt. But if I am investing 6 lakh, then on that 1 lakh, incremental 1 lakh, whatever interest income I earn, that will be subjected to tax under IFRS. So that is required to be considered while filing return of income. There is a rule which is given, rule 90, wherein this particular computational mechanism is given, a very simple computational mechanism, okay, wherein you have to bifurcate. Obviously, this amendment was introduced from 1st of April 21. So balance in that fund up to 31st of March 21 will always continue to remain under the exempt category. So उसके ऊपर 31st March 21 तक के balance के ऊपर जो भी interest आ रहा है, that will continue to remain exempt for lifelong. उसके ऊपर कभी भी कोई tax नहीं आएगा. It is only after 1st of April 21 you have to bifurcate in these two categories, simple categories, mathematical formula which is given here. Yes. Okay.
So last year I provided for the interest because
Correct.
now what happened is the interest and
Okay.
how to deal with this now?
So there are various practical scenarios where actually it happens that the deductor is deducting the TDS in the subsequent year, whereas we are offering the income in this year. If I talk legally, Section 199, Section 198, Section 205, it clearly says that once you offer the income to tax, you should get the deduction of that amount which is credited to deducted by the deductor. According to me, if I am filing return of income, if I am correctly filing my return income, I will have to offer it in this year only, not in the subsequent year. This is a practical situation where at least what I will do is, in the TDS column, I will definitely enter the enter the deduction details कि भाई उसके ऊपर का कितना TDS आता है. Definitely it will lead to disallowance. But according to me, this is the correct way of filing. There are several decisions which says that there is, as per Section 205, there is bar on the direct recovery from the assessee. You cannot recover any amount once it is deducted. Okay, so once the fund itself says that we are deducted in subsequent years, okay, you cannot recover it from the assessee. But definitely, yes, there's a practical issue where the assessee will have to suffer in the first year.
So in this case, can we do that?
Like we used to do in this, FD accrual system में वही होता है. You can come up with a practical way. Correct. I got your point.
All the 20 from their end actually.
Absolutely. It is new for them. PF department generally was passive up to now. Now they have to come into this active mode to comply with all these requirements.
So is that correct? मतलब जो भी TDS आ रहा है उनका
According to me, legal it is not correct definitely, because once you have to offer it. Absolutely. Practically, you have to go by that.
What was TDS in the last year?
Absolutely, absolutely. That's a practical issue, ma'am.
If it doesn't give me that TDS credit, then the client will be
I think they should come up with this issue because if the institution itself is not complying with the requirement which they are doing, I think they should improvise on this aspect.
They should first employ themselves and then
Absolutely,
employ.
absolutely. A representation ought to be made. Yeah, practical difficulties will always be there. Now, amendment in section 1010D, that is relating to unit-linked insurance policies. 1010D provides for exemption when you receive any amount from the insurance company. Okay. However, there are exceptions. So, clause D of that particular this exemption section, that is 1010D, provides that if at all the premium which is paid for any of these policies exceed 10% of the sum assured, then for such kind of policies, if you receive any amount in future, that amount will be taxable, that will not be exempt. So this was, I can say, a percentage or ad valorem exemption, or against the threshold limit which they provided, the 10% of the sum assured. Now in the last budget, they had come up with another threshold limit, that is a monetary direct threshold limit, especially only with respect to ULIPs, that is unit-linked insurance policies. As per this section, it says that any kind of policy which is issued after 1st of February 21, if your annual premium for that kind of ULIP is exceeding rupees 2.5 lakh, then in that case, agar future mein jabhi bhi us particular policy se paisa aata hai, you receive any amount, that will be taxed, it will not be exempt. Same way, it also provide that in case of multiple ULIPs, what you can do is you can claim the exemption in respect of only those policies where the premium is up to rupees 2.5 lakh. So for example, I have 8 policies, ULIP policy, 8 policies. For all of them, I am paying different amount as my premium. Now this particular section says that aggregate of them is exceeding 2.5 lakh. So as such, the first impression is whatever amount you will receive will be taxable. But this particular proviso provides that what you can do is you can cherry pick those policies jiska premium is aggregating up to 2.5 lakh. Utne policies mein se jo bhi aapko paisa aayega, that we will continue to be exempt. But uske alawa jo policies hai, usse agar paisa aa raha hai, it will be taxable. So yes, and whatever income which is taxable, it will be taxed under section 45, subsection 1B, that is specifically provided only for ULIPs in the last budget, section 45, section 1B, that is you have to keep treat it as your capital gains. Now, these were the slides which we have discussed, were relevant, amendments which may be taken into consideration when filing the ITRs. Now we'll be revising certain schedules which are already there in the ITR, but there are specific instruction given in the instruction module which people may not have gone through. Okay, yes, sir, please. Sir, just a minute. I think I have missed out from my slide. The premium which you have paid will be allowed as cost of deduction. Yes. Indexation, yes, because it is not covered by the proviso. I will get back to you, ma'am. According to me, it is not covered by the exception, so indexation should ideally apply. Ideally apply. Because in 48, I don't think so there is any amendment. If it's, this is to, I am not having the exact knowledge of this, I'll get back to you. Sorry, ma'am, can you please repeat? Yes, yes. Again, this is again the same thing, which is a question mark, because even earlier this question was there, whether it is IFOs or capital gain. Now, by virtue of this 1B, they have specifically provided that ULIPs will be considered as capital gain, but that is unit linked. Now, in case of regular policies or in case of at least for ULIPs which are not exempted, I think it should go under capital gains indirectly, obliquely, I can say. Then I think you will have to choose whether you to go for I'll get back to you. There will be definitely, but it is a case specific discussion, I think. Okay, so I think whatever is beneficial to the assessing.
The premium for which I pay only for what?
Yes.
paid and the facility.
Yes. Correct.
And then how to treat those?
In my opinion, in absence of any specific provision, it is open for the assessee whatever is beneficial to them. But then in that case, it will be the onus will be on you. How will you say that it is a capital asset? So all those conditions are still there. You have to comply with the definition of transfer. You have to comply with the definition of capital asset. Whether you call your policies an asset, if yes, then yes, you can go with the capital gains. So ULIPs, this is only for ULIPs. 1st February 2021 के बाद जो issue होगा, only to that particular process this will apply. Prior to that, this provision is no longer in existence. So it will go as per the sum assured वाला जो category था, 10% of the sum assured. It will go by that according to. Only if your premium pays is up to 10% of the sum assured. Now coming to certain relevant schedule, that is schedule FA, that is foreign asset schedule, very important schedule. Well, the residents are required to report the details of their foreign investment or foreign asset held by them. So in this particular table, you are required to report the depository account, custodian accounts, equity and debt interest also, foreign cash value, insurance contract again, immovable properties, capital asset, etc., etc. Now there are instructions which are given in the instruction module which I have reproduced over here. We'll just go through that. If you are resident in India, you are required to furnish this detail of any foreign asset. So for resident, it is mandatory. If you are having any foreign asset, you have to report in this schedule. Resident can be, the ownership can be either beneficial ownership or even you are a beneficiary or legal ownership. Any of these three are there, you will have to require to report in the schedule FA. It is not only that if you are legal owner, then you are required to report. No, even if you are a beneficial owner or a beneficiary, then also you are required to report it. This schedule need not be filled up if you are not ordinary resident or non-resident. So for R and NOR and for NR, that is non-resident, this schedule will not apply. Details are required to be reported even if the specified asset is held even for a single day. So एक ही दिन के लिए भी अगर आपके पास वो specified list item में से कोई भी अगर foreign asset आया है, then definitely you are required to report it in this particular schedule. If you have held foreign asset during the previous year which have been duly reported in schedule FA, even then you are required to report it again in schedule AL also. We'll come to schedule AL, that is applicable only where the total income is exceeding rupees 50 lakhs. So once you report it in FA, that is FA is only for foreign asset reporting. When reporting, while reporting in AL also, you will have to report that again. Okay, that particular asset again in asset liability schedule. So we'll come to that also again. And the rate of conversion naturally because the currency will be different. It has to be the TTBR of the foreign currency as well the exchange rate adopted by the SBI. So this is given in the instruction module. Then period of reporting, very important, a confusion of every year. In this particular schedule, they have specifically provided that you have to report the items or the asset items based on the calendar year. So for this year, in this year's ITR, our year starts from 1st of April, 31st of March. That is 1st of April 22, 31st of March 23. However, in this particular schedule, you will have to report all those assets which are covered from 1st of January 2022 to 31st of December 2022. So even Q4 of this assessment year will not come into picture in this particular schedule. Okay, so please take care of that. So from any asset which is acquired after on or after 1st of January 2023 up to 31st of March 2023 will not be required to be reported in this particular schedule. Details of directorship, again, this is a new line item. This was there, but there is certain additional disclosure which is given in this particular line item. So details of your directorship, whether you are a director in any company or not, you have to report it. If once you select yes, you are a director, you will be, that window will be enabled wherein you are required to report the name of the company, then type of the company, whether it's a domestic company or a foreign company, and even a PAN of the company. Okay, then whether the company is listed or unlisted company, and obviously a DIN number also. There is an instruction which is given in the instruction module regarding this. It says that furnished PAN and DIN is not mandatory in case of a foreign company. So if you are a director of a foreign company, then obviously PAN or DIN to nahi hoga. okay, with respect to that foreign company. However, if the PAN is allotted, then that is required to be reported. If a non-resident taxpayer is a director only of a foreign company, and that foreign company has nothing to do with India, that foreign company is not earning any kind of income in India, then in that case, the non-resident, who may be a director in a foreign country, a foreign company, that particular reporting is not required by that particular non-resident. So he will have to select no, he is not a director of any company. So he has to give the answer in negative. A non-resident taxpayer who is director in domestic company and in a foreign company, but that foreign company is not having any income in India, then his answer should be yes, I am a director, and he is required to give details only with respect to the domestic company in which he is a director. Same way, a resident taxpayer is required to disclose all the details of the directorship, including foreign company or domestic company. Obviously, even in case of foreign company, he will have to report that he is a director, he is a resident, but he is a director in a foreign company. So these reporting requirements are generally missed out, which is required to be taken into consideration. Details of unlisted shares, again, very important, because nowadays there has been quite, I can say enhancement or frequency of transaction in, contributing or investing in an unlisted company like startup, etc. This reporting requirement is very important. You have to report whether you have invested in any unlisted company or not. If you say yes, then you'll be asked certain details like the name of the company, type of the company, PAN number, what is the opening quantity of shares, what is the cost of acquisition of the shares, okay, what shares acquired during the year, what is the during the year, what additional acquiring is there, and what is the amount which you have transferred or sold off. Certain instruction which are again given in this instruction module for this particular reporting. If you have held shares of a company during the previous year which are listed on a recognized stock exchange outside India, then such shares will not be required to be reported in this schedule. So foreign country में अगर कोई listed shares है आपका recognized stock exchange in the foreign country, then that shares will not be required to be listed in reproducing this particular schedule. In case of the PAN of a delisted company cannot be obtained, you may enter this particular PAN. So there will be a delisted company where you are holding the shares of such delisted company. PAN will be compulsory, but because you are not having the PAN, you can write this particular number. In case unlisted equity shares are acquired or transferred by way of gift, bill, amalgamation, merger, demerger, or bonus issue, in such cases, you may enter 0 or appropriate value as the cost of acquisition. Naturally, if you are receiving any unlisted share as a gift or any other, by way of a corporate action, etc., then in that case, the cost of acquisition will be 0. And so in this schedule, it is mandatory to write COA, that is cost of acquisition, where you can write 0 or the appropriate cost, whatever it may be. Now, please note that the details of the unlisted shares held during the year are required only for the purpose of reporting. The quantitative details entered in this column are not relevant for the purpose of computation of tax liability. So, यहाँ पे you will be asked the opening balance during their acquisition, during their sale, and the closing balance, quantity as well as the amount. So, this particular schedule is nowhere linked with the income computation. Okay, so you need to remember that while reporting in your CG, you will have to make a separate disclosure. Okay, so that is the instruction which they have given. Now, again, very important. Even in case where you held unlisted equity shares as stock in trade during the previous year, you are required to report the same in this clause. So, say suppose you are dealing in shares and you are having some unlisted shares as your stock in trade, then also in this particular schedule, that is investment in unlisted companies, you are required to mandatorily provide that details of that unlisted shares. You are not required to provide details of cooperative banks, shares or securities held of a cooperative bank or cooperative society in this particular schedule. Now, in case of ITR 6, there is a new schedule which was introduced last year, that is investment in unincorporated entity. Unincorporated entity, even the companies are now investing in other companies which are unlisted. So this particular schedule was there only for individuals and other categories, but not for companies. So in the last year, they had introduced this schedule IF, wherein these details which are required even in case of individuals are asked again in case of the companies. I'm just running through this slide. 112A we have been filling up since last 3 years. Yes, please. FNO transaction in the sense Ma'am, can we take it at the end? Okay, fair enough. I'm ready to schedule AL in the press release because that is relevant, applicable since last 3 years. We all know all this. Schedule 112A. Schedule AL, again, asset liability schedule. It is mandatory to report in this schedule if your income is exceeding rupees 50 lakhs. Individual also. In case you are individual and you're filing ITR 3, that is, you are filing your balance sheet. Then once you have reported certain assets in your balance sheet or in certain liabilities in your balance sheet, that part will not be required to be reported in AL. In AL, you have to report other than those which are covered by Schedule A, this Schedule BS. Asset and liabilities at the end of the year are required to be reported. If you are a non-resident or resident but not ordinary resident, only the details of asset located in India are required to be reported. So for non-resident and for R but NOR, okay, only the asset which are in India, even in Schedule AL, is required to be reported. Okay, so this is what they have provided. Again, if you have held foreign asset during the previous year, which have been duly reported in FA, in case of residents, even if you are reporting in FA, you still have to report again in AL in case of residents. Yes, cost of acquisition, they have given that actual cost price you have to consider while reporting in this schedule. AL, you have to report the cost price and not the market value. So I have seen certain return of income that in schedule AL, when they disclose their asset and liability, they write the value of market value of the shares on 31st of March. No, please don't do that. It will end up, the officer claiming that you had acquired, you had this amount as cost of acquisition. So please report the cost of acquisition, which is the actual cost of acquisition in this particular schedule. In case of company, also this schedule is there. Schedule AL again, AL1, that is required to be filled by unlisted companies only. For listed company, this schedule is not applicable. Even if the assets are held in stock in trade, still they are required to report in this particular schedule, and wherein they have to report the purpose. The purpose is as stock in trade. So there will be immovable property, there will be current assets, wherein there will be a drop down. And in drop down, you have to select that it is for the purpose of stock in trade. But you have to report even the stock in trade in this particular schedule. Now, again, a legal issue, dividend classification of dividend. In last year's ITR, they have made this change only in the ITR, not in the Act, nowhere in the Act. In the Act, there is already a provision, section 56(2) clause 1, which says that dividend income will be taxable under the head of income from other sources. However, there is certain decision which says that when that particular assessee is itself in the business of dealing in shares, the dividend income cannot be considered as IFOS, it has to be considered as business income. There are decisions contrary as well as for and against the assessee. But yes, definitely the people used to take a particular stand based on their own criteria. However, in last year's ITR, what they have done is under Schedule BP, they have introduced this line item saying that whatever dividend income you earn, you have to compulsorily exclude it from Schedule BP and it will go into IFOS. So they are mandatorily requiring you to report your dividend income only under IFOS. Whereas there are decisions which supports the view that yes, dividend income can also be considered as business income. So this is one of the things which was there even the last year. Even in this year, you have to take care what stand you have been consistently following in your clients. So this is that schedule wherein the dividend income will be excluded. Now, when you're reporting dividend income in IFOS, you have to make sure that you report the point of accrual of the dividend also in that particular breakup schedule, because it has impact on 234C. So 234C gives an exemption, it's a relief in case of dividend income, capital gains and certain other income, okay, where you cannot predict कि आज के दिन पे कि मेरे को पूरे साल में कितना dividend आने वाला है. So 234C give relief to that extent that once if you are earning dividend income and if you are paying your advance tax after the receipt of that dividend income in the subsequent quarter, we will not burden you with the interest under section 234C for the entire year. However, this is possible only if you report it properly in that particular breakup schedule which is given in schedule IFOS. If you don't give this breakup properly, CPC may calculate on the entire, considering that this income was estimatable for the entire year, and accordingly they will calculate what was the advance tax liability, and 234C may be applicable. Generally, what happens is, practically, what people do is they just enter the entire dividend amount in the last quarter, so that there is no question of, levy of interest under 234C. This is the practical way people are following. But if I talk about the legal way, this should be the way, and you should report it properly so that CPC will reconcile this quarter-wise details with the advance tax details. and accordingly 234C relief will be given. Absolutely, but I think for that there is there schedule is there. Yes, obviously because of the paucity of time, and it is very difficult to categorize unless you have a very good software wherein you everything is coming ready to hand. Now, one more important amendment, that is section 57, that is deduction in respect of the I can say interest income for the dividend which you have earned. This particular amendment was made even in the last year. It says that against your dividend income which you are reporting under IFRS, if you are reporting, then in that case only income expenditure will be allowed and no other expenditure will be allowed. So clause D provides that whatever expenditure you are incurring exclusively for earning that particular income, then that particular expenditure will be allowed as deduction under section 57 clause 3. This proviso says that in case of dividend income, you can only claim interest expense and no other expense. And that too restricted to 20% of the dividend income. Now, there will be some legal issues over here also, according to me, like we have some issues in 3613, that is own for borrowed fund. What if I have invested 5 lakhs from my own fund, 5 lakhs from my borrowed fund, and I have invested 10 lakhs in the shares. I have earned 1 lakh rupees as the dividend income. I am offering it at 1 lakh rupees in IFOS. However, assessing officer will say 20% of the dividend income that comes to as such 20,000, but officer may say that आपने market से जो borrowing लिया है that is only to the extent of 5 lakh. So correspondingly only 50,000 will be available for you to claim deduction, and 20% of 50,000 should be taken and not an entire 1 lakh rupees. The same issue which we have in 3613. Okay, so this is also one of the legal issues which needs to be addressed. Please note that this 20% of the dividend income is the restricted final amount. Even if you are incurred more than expenditure more than that, it will not be allowed to be carried forward. No. Okay, 20% is the final amount. There is one legal point I have covered in this particular aspect with respect to whether to treat it as an IFOS or not, dividend income. A very good case law is there. I have covered it in the later slides. We'll discuss on that. Now, again, a very small note which was given in the ITR instruction module with respect to maintenance of books of account. So you have to select whether you are required to maintain books of account under section 44 AA or not. So in case if you are engaged in a specified profession like legal, medical, engineering, architecture, economics, etc., it is mandatory for you to maintain books of account irrespective of your income. Whereas in case of non-specified professional or business, it is based on your income limit or the turnover limit, which is given over here. So you have to specify whether yes or no, whether you are required to maintain or not. Once you say that yes, you are required to maintain, there is a note given in the instruction module which says that please make sure that if at all in your 3CD, if there is any amount which is reported as not routed through P&L, there is a line item in form 3CD wherein the auditor is required to check whether there is any income which is not routed through P&L, but it is includable in total income of the assessee. Okay, so that income is required to be reported in 3CD and the auditor is required to verify that. So if that amount is there, is reported in 3CD, make sure that even in a return of income, you fill that schedule, you fill that line item which is also given in schedule OI. So many a times OI is left, like blank. So make sure that you fill that figure in OI. If you don't fill up that figure in schedule OI, the CPC will automatically, take that figure from 3CD and add it to your total income. It is possible that some of the people are reporting that directly in schedule BP, any other income category. Directly they are adding it to there, but they are not disclosing it in schedule OI. They are included in total income, but it is through BP schedule and not through OI schedule. So this instruction says that please route it through OI schedule so that there will not be any mismatch by the CPC. Yes, please, sir. Correct. Okay, sir, please.
What is the prevailing? Whether 44 prevails?
Sir, if I read bare provisions of section 44 ADA or section 44 AD, it nowhere says that you are not required to maintain books of account. It nowhere says they are not required. It says that once you violate these conditions, you are required to maintain books of account. It's the otherwise. There is a difference between both of these statements. So first of all, if I go by the bare provision, there is no provision in 44 ADA which says that you have to maintain books of account or you are not required to maintain the books of account. But if you're falling under 44 ADA, which means you are even covered by section 44 AA, which requires you to maintain books of account. So in that case, it will not be regular books of account, but at least some books of account which will help the assessing officer to assess your income. So that is what is provided in section 44 AA. So, sir, your estimation will be based on something, your bank statement or some cash book or some register. That is nothing but your books of account. Absolutely, yes, yes, yes. That is also altogether different hectic. We'll cover it. We'll cover it. So, sir, if you refer to CBDT website or the e-filing website, there is a FAQ on section 44 ADA and section 44 AD FAQs. Only in that FAQs, they have directly stated that you are not required to maintain books of accounts if you are opting for 44 AD. In the Act, section 44 AD nowhere says that you are not required to maintain books of accounts. No. So this is some legal reading which is required, but yes, FAQ says that fine, you are not required to maintain books of accounts. 44 AD indirectly says that if you violate provisions of section 44 AD, then now you are required to maintain books of account, which obliquely means earlier you are not required to maintain books of account. Yes. Sir, you are required to maintain at least bare category of books or any record which will help you yourself in determining the income. Sir, that is what I am telling you, that your bank statement or your any loose paper wherein you record your receipts, you have to compute your total income. That is to be done by you, not by the officer. So for whenever you're computing your total income, you must have something on your hand which can substantiate that, yes, this is my income. It is, sir, it is, but obliquely, yes, it is. So no. You have to say no, sir. Whether you are, so my question over here is whether you are liable to maintain books of account or no. Yes or no. Correct. Then your reporting should be in schedule 44 ADA and not in the regular balance sheet. There is a separate line item for No, sir. See, once you opt for 44 ADA, first of all, here you will say no. In 44 ADA, you have a separate 4-liner balance sheet. Again, I will go to CBDT FAQs, which says that if you are opting for 44 AD or 44 ADA, you are not required to maintain books. So this is regarding reporting schedule OY. Now again, a very favorite question which is always asked regarding, this is the most second favorite FAQs. I can frequently ask question कि अगर मैंने अपना profit 8% से कम दिखाया तो मुझे tax audit applicable होगा नहीं. Even today, every year this question comes up. I'll just brief you up with this since we have a very less time left. Up to AY 1617, there was a specific provision under section 44 AD which stated that once you declare your profit below that specified profit rate, you are required to maintain books of account and get them audited. So specific direct express provision up to AY 1617. In that case, if at all you had your income above the basic exemption limit and you declare a profit less than 8%, in that year, only in that year, you're required to maintain books of account and get your account updated up to AY 1617. From AY 1718, the new provisions came into force, section 44 AD, subsection 4. Subsection 4 says that if in any year you have opted for 44 AD and subsequently after opting in any of the next 5 years, you are not opting for 44 AD, then in that case, you are required to maintain books of account and get them audited for the subsequent 5 years. You are not eligible to again re-enter that scheme of presumptive taxation for the subsequent 5 years. Now, the question is there is no requirement given under this particular section, or even under section 44 AB, or even under section subsection 5 of section 44 AD, which says that my profit is less than the specified profit rate, and hence I have to get it audited. No, you have to get it audited only when you violate that particular provision saying that आपने पहले कभी opt किया था 44 AD, or in the next 5 years you are opting out. Once you opt out from that year and for the next 5 years, you are required to maintain books of account and get them audited. This is the criteria according to me in my reading. There is no such criteria right now which says that just because my profit is less than 8%, I have to get it audited. No. So can there be a scenario where my profit is less than 8%, still I am not required to conduct tax audit? Yes, there can be many scenarios. I'll come to that. The very first scenario is, this is my first year of business. Very first year of business, I am maintaining my books of account. My turnover is say rupees 80 lakh, not exceeding 1 crore, 80 lakh rupees. My profit is only 1,000 rupees, only 1,000 rupees. That is below the specified rate of 6% or 8%. Now, in this case, there is no requirement to conduct audit because there is no violation of subsection 4 of section 44AD. Subsection 4 of 44AD कभी apply होता है? तभी apply होता है जब भी आपने पहले किसी साल में opt in किया हो और उसके बाद वाले साल में आप opt out कर रहे हो. या तो मेरा पहला ही साल है. There is no question of opting out. I am not opted in at any point of time. And hence, in my opinion, personal opinion, in this scenario, even if the profit rate is less than 8%, there is no requirement for conducting tax. Same way, there can be a second scenario where I have been carried on my business for long years. Every year, I have been maintaining my books of account and I'm getting it audited. In this year, it's the first year where my turnover is less than 1 crore, or इस साल मेरा mood नहीं है कुछ भी audit करवाने का, I don't want to maintain books of account anything. I want to go for presumptive taxation. In this year, my profit is less than 8% or 6%, whatever it is. Still, I am not required to conduct audit because in any of the earlier years, I had not opted in for 44AD. 44AD4 or subsection 44AD5 will come into picture only when you have opted in, and in the subsequent 5 years, you are opting it out. In both of these scenarios, it is not happening. So again, in my personal opinion, tax audit is not required in this kind of scenarios. Yes, sir. Sir, I think there is an express provision in the act. Once you go for presumptive taxation, it will presume कि जो भी आपने किया है, okay, that is after giving effect to everything, every kind of deduction. I think the section start with notwithstanding anything contained from section 28 to 43D. That is how the section starts, according to me. So it covers even 32. Okay. Got it. I'll come to this scenario. Very simple scenario. Say, for example, last year I opted in for 44AD, presumptive taxation. This year, my turnover is 7 crores and there is no cash expenditure, there is no cash receipt. Everything is on bank. As per section 44AB, clause A, because of the threshold limit, I am not required to do audit. Now, the question comes to this angle, whether 44AD4 will apply or not, or whether 44AD5 will apply or not. In my opinion, it will not apply because by force of law, you are getting out of it. You are not opting out. It's not voluntary. It is by operation of law, you are not covered by 44AD. So there comes no question of applying 44AD4 to you. This is my personal opinion. Department may have a contrary view. And you, because you're covered by clause A of section 44AB and your turnover is below the 10 crore and the expenditure criteria, you are not required to do it. Absolutely. Books of account is required to be given. Yes. Yes, in this scenario which we have discussed. Definitely yes. Definitely yes. Now, just few judgments which are very fascinating and relating to ITR. I will be discussing at a fast speed now. Very fast is very interesting, a very fantastic judgment when it comes to interpretation of statutes. Wonderful judgment of Karnataka High Court, recent judgment 2022. Interesting scenario. Assessee had in this particular year brought forward business loss of 40 lakhs. Brought forward business loss of 40 lakhs. In this year, there was no business, there was no income, nothing. But this year, there was capital gain of 98 lakhs from sale of land and equipments or land or machine, whatever, some capital asset. There was capital gains in this year. Now, what assessee did was, assessee ne capital gains jo aaya 98 lakhs ka, what he did was, against that capital gains, he had set off that, brought forward business losses against this. Now, if by general reading of section 72, if you see, it says that 72 allows you to set off your business losses against your business income during the year. And in the subsequent year, you can carry it forward and you can again set it off against your business income itself. You cannot go into other house. You cannot go into other head once you surpass the next year. I mean, in the next year. During the year, there is a possibility again, at least against LTCG, there is some criteria which needs to be complied. So special bench of ITAT as well as the CIT lower authorities stated that as per 72, you cannot set off your capital gains against brought forward business losses. Now the interpretation comes in the picture. Section 72, subsection 1. It says that whenever you are incurring losses, now please read it, under the head profits and gains of business and profession. They have used the word under the head of business and profession. So whenever you are incurring losses in that head, you first set it off against that same head. Usi head ke andar dusre business hai aapke, uski income ke samne aap set off kar. If there is still accumulated losses under the head of business and profession, then as per clause 1, you can carry it forward to the next year. And in the next year, you can set it off against profits and gains, if any, of any business or profession. So yahan pe the High Court says that when it comes to during the year, section 72 subsection 1 says that under that head, whatever income you have earned, you can set it off against the losses under that head. But when it comes to the next year, when you're going to the next year, they have used the word, it shall be set off against profits and gains. They have not used the word under the head. So now the High Court says that ultimately, ये जो भी selling of land हुआ है, factory building हुआ है, that is nothing but their business activity. It is related to their business. मेरा company है, company का building है, मैंने बेचा है. For the purpose of income tax, I am bifurcating into 5 heads. Otherwise, everything is my business. So whatever income is earned from this activity also, okay, whatever income is earned even though it is treated as capital gains, but still for the purpose of 72 subsection clause 1, it will be allowed to be set off. So your brought forward business losses will also be allowed to be set off against your current year capital gain, which is otherwise not in our head. It's something out of the box. See, shares ka, if I am a dealer in shares and I have long-term capital gains, in that case, if I talk about 112A, then I think there is a specific restriction given in that section stating that, no, I think even in that it is possible, no? Why not? There is no provision in 112A which prohibits you from setting off your other losses against 112A. I mean, in general, the capital losses. But this is an interpretational issue which is always subject to litigation. This is a very classic case of interpretation. If you read the judgment, it's a very good case, which I think utility calculates directly, automatically. They pick up some figures. Okay, it may not allow. But if you want to stick to this stand, you have to make a representation and a paper form to the CBDT. There's a Bombay High Court judgment of Samir Bojwani and SK Ventures, which says that just because ITR form does not allow, that does not mean that there is no law for that. I think the Supreme Court judgment of LIC Corporation in context of some other law, which says that the forms will not override the statute. What the statute does not prohibit, you cannot prohibit by way of a form. All these are legal issues. But yes, if you want to take up a stand for that, you can definitely go ahead. Your ma'am, the factory building was there, it's a capital asset, no? Fixed asset. That was the issue. Now, another recent Bombay High Court judgment, a very simple judgment, I'll just run through it. we know that certain statutory forms are required to be filed. Okay, if you want to claim certain exemption or tax audit report is required to be filed on time, certain forms are required to be filed on time, even by the chartered accountants, 10 CCB, etc. Okay, so there was a delay in filing this particular form on the part of the chartered accountant, and there was a delay of 36 days. The CPC had disallowed this particular exemption because the chartered accountant certificate was filed belatedly. Before the High Court, it was pleaded that the chartered accountant himself or herself had accepted that it was lapse on her part on account of certain personal obligation. High Court said that yes, please severity, you have to consider this. Okay, the important observation is that due to the default on the part of the professional, the assessee should not suffer. So this is a very important observation is given in this judgment. Okay, that assessee should not suffer because of the professional, because there was delay on part of the professional. So if at all there is any sort of delay or something like that, if you have a reasonable stand, then yes, it will be heard by severity or by the High Court. Again, interest under section 234 ABC, as the madam pointed out, कि कभी-कभी ऐसा होता है कि in the subsequent year they are deducting the TDS. Okay, whereas you are offered your income in this year. In that case, also what happens is once you claim that amount as deduction, they will disallow that amount of deduction of TDS credit, and they will also impose interest under section 234 ABC. This is a judgment, recent judgment of Gurpreet Mohan Singh, wherein the Honorable ITR stated that you cannot blame the assessee for this. Once it is proved that the deductor had deducted tax on it, but he had defaulted in payment to the government treasury, you cannot even recover the interest amount from the assessee. You have to, whatever you want to do, you do it from the deductor, not from the assessee. Again, this Satish Cold Road Storage Lucknow Tribunal is a judgment, very important judgment when it comes to filing of Form 10 CC for ATIB. In this case, also a reference is made to CBDT circular. A very good, I can say, reference is made in this judgment. It is stated that as per this particular provision, it was stated that unless Form 10 CC is filed on time, you cannot avail the exemption under Section ATIB. So that was filed belatedly. However, before the expiry of the time to file revised return, the assessee had filed a revised return wherein Form 10 CC was submitted to them. So Honorable ITR in this case has referred to a CBDT circular of 1984. That circular is still in subsistence, and it was held that in that circular is provided that whenever you want to make any adjustment under 143(1), so this adjustment was made under 143(1) because tax audit this particular form was filed belatedly. So this circular says that if the assessee is approaching the assessing officer, okay, within the limit of 139(5) and read with section 154, that is for rectification application along with that particular form, then it has to be considered by the assessing officer. So even this judgment can come to a rescue in cases where there are delay in filing this particular statutory forms. Now coming to the last part of our discussion, that is the annual information statement. Now, first of all, we look at the source of law. The annual information statement or Form 26AS. Earlier, it was covered by Section 203AA. 203AA covered the provision of 26AS. Now that is completely omitted. There is no 26AS, which was there earlier. Now the relevant section is 285BB, which is covered, the provisions of which are given under Rule 115I. Under Rule 115I, they have prescribed that there will be Form 26AS, and hence even today you are seeing Form 2 and Form 26AS. This particular Form 26AS captures various details and data from various sources. These sources are notified under this particular two notifications which I have enlisted over here. So यहाँ से reporting होता है 285BA के अंदर. 285BA SFT reporting is done. Based on that SFT reporting and other sources, based on this source of circular, okay, they report the transaction in your 26 years. Now, 2 years back, our finance minister had announced that we will the scripture the entire utility in such a way that entire return will be filled. So that was her statement in the budget speech, wherein she stated that we will make a return filing so simple that entire thing will be pre-filled. In order to comply with this, or in order to encourage this kind of simplification, they have come up with this e-campaign. Under this e-campaign, there is no sort of law as such, because under this particular section, there is this e-campaign. This is the administrative part. Everything is voluntary in this particular e-campaign. There is no law which mandates me to reply to this e-campaign. But what will be the consequences of not reporting? We'll discuss it later. So this is the, I can say, certain points which are taken up from the manual or FAQ of the e-campaign. It is not my points. It is directly taken up from that particular schedule. The objectives are to collect taxpayer details and selected information for queries, to promote voluntary compliance. This is the voluntary thing which is required to be done by you. Okay, so this responses which you have filed under this particular e-campaign or to the AI statement will be processed by them, and it will be helpful for them in pre-filling your return of income. So this is the way they have structured this particular e-campaign scheme. Now there is two categories. One is preliminary response and other is feedback on information on AIS. These are the two categories. The first category is preliminary response. Presently only one category is there in case of non-filers. So if you are a non-filer under the AIS information, you will get this preliminary response category where they will ask you, why are you non-filer? What is the reason for you not filing the return of income? That is the drop down which they have given, that your income is below taxable limit, you are covered by XYZ provision, etc. So this is a general reply. Only one question is asked over here, which is required to be given. Now, second thing which is commonly being asked by many persons as to how to comply to this AIS feedback, which they are now sending notices to us. So in this case, this is the second category, that is feedback to the information in AIS. This functionality as such does not have any binding source of law. कोई section के अंदर कहीं पे भी नहीं लिखा है कि you have to reply to this. Okay, this is the administrative part according to me. Now this particular functionality collects the information from various sources as notified in the particular notification, and they will dump it on your portal. And on the portal, they will give you two categories. One is optional category, one is expected category. So in the expected category, the department expect you to reply to that category कि भाई वो transaction क्या है. You have to give your feedback whether the reported transaction, whatever transaction reported in that particular schedule, whether according to you it is correct or not. You have to give answer yes or no, or vice versa. So this is optional scheme. Optional tab is always optional. Whether you want to opt in or whether you want to fill it or not, it's upon you. But expected, they expect you to answer. Now, what are the drop down? What are the kind of answers which you are, you can give to this each and every field of this particular tab? You must have seen that there are various kind of information like interest reporting. There is even reporting of all the shares transaction, mutual fund redemptions, okay, securities transaction, etc., immovable property transactions. So for each of this category under this expected tab, you will get a drop down, and based on the drop down, they will process your information. So now you have to answer. So for example, there is a transaction which is shown. Say for example, there is a transaction of mutual fund redemption which is shown. They will show you entire transaction as per the reported. कि भाई वो कभी acquire किया था, what was the date of acquisition, what was the cost of acquisition, what is the index cost of acquisition, what is the date of sale, what is the unit sale price, etc., etc. Everything is there. Now you have to say whether it is correct. If you say it is correct, then it will be reported directly into your AIS report. So we have to report AIS, TIS. So in the AIS report, once you say that yes, it is a correct transaction, it will be accepted and it will be reported as it is. That single value will be reported in the AIS schedule. If you say that information is not fully correct, so for example, you have some discrepancy with respect to certain amounts. So say for example, there is reporting made of 10 lakhs, but as per you, the amount should be 7 lakhs, not 10 lakhs. So you are modifying that value now from 10 lakhs to 7 lakhs. So in this case, you have to report it. So if I show this schedule to you, this is the entire schedule. All the line items are there, quantity, rate, type of asset, everything is there. You have to give your feedback as per your understanding, as per your computation of income, and you have to provide your feedback. Once you provide your feedback to them, there will be like two values. One is reported value, that is reported by the reporter, that is under section 285BA, SFT transaction. Second value will be the modified value. Modified value is the value which you have entered. And the third value will be the reported value. Reported value will be the two values will be reported in your AIS statement. They will report both the values. कि भाई SFT transaction reporter ने क्या report किया था और आपने क्या modify किया. Both these values will be reported in your AIS statement. Okay, so this will come into your AIS statement after you give your response to that. Okay, and this they have stated in this particular FAQs that once you give this detail, they will process it as per the risk management strategy. Okay, and if there is a significant variation from what has been reported, then they even send the data to that again collector, back to that collector, and they will ask them कि भाई इसमें कोई discrepancy है क्या, and then we will collect the detail. But in your AIS, whatever value you will report, even that will be reflected in your AIS along with the reported value. Then there is a duplicate information. Say for example, there is a transaction which is entered 2 times in that particular statement. Then automatically once you say that it's a duplicate transaction, the value will be considered as 0. So in your AIS also, earlier, if you have not submitted any response, then in that case, 2 transactions will be reflected in your AIS. Same value, 2 transactions will be reported. But once you say that it is a duplicate value, in AIS, it will be modified to 0. एक रहेगा पूरा transaction, दूसरे में 0 आ जाएगा, and उसके बाजू में it will be, even the earlier figure will be reported. But here, at least they will make some correction in the AIS once you report it, if you report it. If you don't report it, then again it will be like the entire amount will be reported.
It is also doing the rate.
Okay.
So one of the transactions is duplicate.
No.
Both are separate, income is one only.
See, one is GST reporting and other is TDS reporting.
But
Correct. No, but according to me, there is a separate category of information, and we have this notion that whatever is reported in AIS, it will is your income. No, ऐसा नहीं है कि AIS में आ गया तो आपका income हो गया. नहीं, the ITR will prefill it as your income. No. Okay, so if obviously if it is a GST turnover reported, then it will not take that as a prefilled item for a return of income. Never. It will take the TDS wala rent wala item as a in your schedule of rent income, definitely, but not the GST. They have classified it in that way. You cannot say it as a duplicate. No, I don't think so. Huh. Separately, yes. Yeah, correct, sir, correct. Yes, sir. Okay. Sir, it's a legal issue. It's a legal issue because otherwise, if it is listed, then you are not allowed to claim the indexation benefit that is expressly given. Once it is delisted and you are selling it, okay, there is no prohibition, but department may take a contrary stand that cost of when you acquired it, it was listed. Then there will be a categorization up to the date of delisting, you cannot take indexation, and after that you can take it. It's a legal issue, sir. So delist okay, I don't think so that company will be in any way to report anything about it. I don't think. Company, sir, if you're having a private party transaction, only if it is covered by 285BA, then it will be reported. If the company is selling that shares to you, then it might be reported because first of all, it has to be a reportable entity for under section 285BA in order to get your transaction reported in AIS. If you made a private party transaction and that party is not covered by the provision of 285BA or Rule 114E, then there comes no question of reporting in to SFT. Okay. Yes, sir. Yeah, sorry, sir. Is a technical issue, maybe. Yeah. Yes, sir. But strike off हो गया तो सर shares होता ही नहीं है ना, फिर क्या करें? There is no shares. Before striking, as per the provision of the Company Act, the shares are automatically scrapped. Yeah, possible. Yes. So another, sorry, sir. No capital, sir. All these are legal issues. Striking off itself of the company can result into transfer of capital asset. If I am the lawyer of that particular person, it is like you're striking it off, you're writing it off. So मेरा जो भी loss है, I'll claim it in that year. Yeah, absolutely. I have no claim over that shares now. Now, another information category or the drop down is information related to other PAN. This is very important when it comes to joint purchase of property. बहुत टाइम ऐसा हो रहा है कि only single PAN is reported. Or in case of partnership firm ऐसा होता है, if it is an unregistered partnership firm, the registration is done to the partner's PAN. Okay, there is no PAN of firm which is involved in the sub-registrar office, because of which the property is reported in the 26 years or AIS of the person, that is a partner and not the firm. So here, definitely you are required to give the details that no, this property does not belong to me, it belongs to someone else. So to specify the PAN over there. So I think the ये सब issue पहले थे, which were like unaddressable. There are practical issues which are not being addressed because ऐसा कोई mechanism ही नहीं था. Now there is this mechanism where they will ask you कि भाई आपका नहीं है तो बताओ किसका है. Okay, and accordingly in your AIS it will be modified. Yes. Correct. Anything. Absolutely. One. Yes, even that. If they give you this optional table or expected table, if you are able to reply to it, then yes, definitely. Ultimately, all this feedback is going back to the portal wherein they will modify your AIS. So AIS it will be modified to the extent whatever you have reported. Okay, and according to me, be it 26 AS, be it TIS, ES, anything, as per section 4 of the act, nothing can override section 4. जो मेरा इनकम है उतना ही टैक्स होना चाहिए, चाहे वो किधर भी किसी ने भी कुछ भी रिपोर्ट किया हो. That's it. And if I'll come down to FAQ which is given by the department themselves. We'll come down to that. Before that, this small category, if the information is denied, say for example, someone has reported your transaction in their SFT, okay, citing wrong PAN. So आपका गलती से PAN डाल दिया है, because of which the transaction is being reported. Now in this case, the transaction is not belonging to you. You have to deny the transaction. You don't know whose transaction it is. You have to just deny it. Okay, so even that category is given over here. Then transfer is not in the nature of sale. So sometimes you have gifted some property to someone. So it is not in the nature of sale. So you have to mention that there is a transfer of property, but it is not in the nature of sale. Okay. Same way, income is not taxable. So there are certain exempt income which are reported and they expect you to give the answer. So you have to reply to it that this is an exempt income which is being reported. So once you give this answer, they will process it. If you are not giving this answer, they will directly transfer this data to the risk management strategy. And now, as per the new provisions of section 147, explanation 1, clause 1, okay, even if the information is received through risk management strategy, it will be an eligible criteria for reopening the assessment. Okay, so better that if there are a huge transaction where you already know that this is required to be properly reported, I will advise you to report it. Otherwise, there is no obligation by law to report this transaction. Ki, haan, bhai, ye mera hai, nahi hai. I have one client who is dealing regularly in mutual fund. There are more than 5,000 entries in this AIS. 5,000 entries which are expected. So humanly, it is impossible for me to select each and every details. So now in that case, we'll have to practically find out a way out कि भाई या तो मैं नहीं करूँगा assessment आएगा तभी समझाऊँगा. Because these are the information which is not mandated by law for me to give it to the department. Okay, and merely on the basis of that, assessing officer cannot say कि नहीं आपने इसका जवाब नहीं दिया, इसके now I'm adding it. No, that is not possible because there is no source of law for that. Definitely, sir. Yes. Correct.
So you are saying that
Absolutely, sir. So it will facilitate. Yes, definitely. It will facilitate the filing of return. Okay, very smoothly. But there are practical issues for that also. Time constraint, human resource constraint. Say if I employ someone, I don't know how he is going to input the values. My brain and his brain may be different. Yeah. So now there is also one FAQ which is very important, whether the information can be modified or not. Very important. So they have categorically stated that yes, you can modify. Once you file a reply, subsequently you see that there is error in filing that particular response to the AIS. You have all right to modify that. You have to give reason why you are modifying it. So it is like earlier response provided was by mistake, or incorrect details were given, or response was no longer valid. Now that response is no longer valid now, or others. If you select others, you have to give the reason to that. Why are you modifying? So that modifying thing is also been provided. So nothing to worry about that. Now this is very important. Last part of my presentation, departmental FAQs. Now there will always be a question. There is a difference between 26 and AIS. What should I follow? Okay, so this has been addressed by the department themselves. I'll read the answer to this. Difference between income as shown in AIS and 26 years. Income reflected in AIS and 26 years are based on information received from different sources and the tax compliance made by different stakeholders. These are made available to the taxpayers for reference purpose. Taxpayers should check this book of record and provide information in return as per the information available with them. Second part, very important. They should provide the information as information available with them. If there is variation between the TDS, TCS or tax payment as provided in 26 CS and TDS, TCS or tax payment provided in AIS, the taxpayer may rely on TDS payment provided in form 26 AS. So here they have categorically stated that if there is difference between 26 CS and AIS, at the end, कुछ अगर reconcile नहीं हो रहा है, you can go by form 26 CS. And I, as a legal profession, I'll say to you that there is no need to go even by 26 years if the 26 years is wrong. You have to go by the act. But yes, to answer the query whether what to follow, AIS or 26 years, department says follow 26 years. So this is the last question. Probably, sir. So in 26 years, ultimately everything is coming for SFT. Okay, but there will be some, definitely there will be some balances or, you know, some things which may not be reported. Probably. And now we have in the social media, this last week we have come across a notice which was issued by some officer in Jammu and Kashmir, Udhampur. This was a notice calling for information under section 133 subsection 6. Notice was issued to that particular assessee asking the details of the tax professional who has filed the return of income. So such kind of notices are being issued now under section 136 to the assessee seeking the information as to who had filed a return of income, whether you had given the details of the deduction which are claimed by you or not to that C or not, whether you yourself had verified the ITR or it was the tax professional who had verified the ITR. All these kind of details are being asked now from the assessees. So as a professional, we should take care that we should take proper MRN from the assessee or proper documentation from the assessee, because आगे जाके वो assessee अपने साथ है नहीं है, किसी और ने कुछ गलत inform कर दिया, then I think you will be covered by that particular, you know, notice, and then they will also come behind you that why have you reported misreported or anything if misreported. So yes, this was, I think, the last part of my presentation. Only one important FAQ, very important FAQ which comes up every year. I think you will guess the question from my answer. That is this. It is not going to get extended. Okay, due date is not going to get extended. So this is most frequently asked question. Yeah, so with this, I think I'll rest my presentation for the day. We can take up the question answer session for the ITR aspects. FN, yes, coming to that. Now, FNO as such is covered by the exception to section 43, subsection 5. It is not considered as speculation. It's a normal business transaction. Simple. Now, as per section, as per para 5.14 of the CBDT guidelines or tax audit. Again, for FNO, they are saying that whatever, you know, premium paid, you have to take it in modulus, that is your turnover. Simple. Tax audit guidelines says that that will be your turnover. If you want to opt in for 4480, there is no bar on that. Even you can opt for presumptive taxation in case of speculation transaction. Derivative transaction. Okay, but again, the turnover will be calculated as per the ICI guidelines. If the turnover is crossing that limit, then you cannot go for 4480. Otherwise, you can go. Now, in section 4480, if you're going by that, in my opinion, you directly have the figure of profit. You directly have that figure of profit. In my opinion, you have to report that figure as a profit. You cannot just assume 8% or 6%. And turnover will be according to the ICI guidelines, I can say. Okay, but it should be within that particular limit. That's it. So if there is a loss, there is no question of coming into 4480 first of all. Now, if you're maintaining your books of accounts, etc. In that case, practically how it is reported is, what we do is, whatever premiums wherein there is income, we consider it is in the sale part. And wherever there is losses, what all script transaction losses, we consider the debit side. So this is how we come to the net figure, that this is the net loss. Absolutely. Some of them are directly showing the net figure in schedule BP also. That is also done. But what we generally follow is to show the positive side on the credit side, negative side on the debit side, ultimately will come down the loss. In balance sheet, there will be nothing. No, it's a derivative. It will be squared off. Only your capital balance with the broker can be reported. Yes. So if you have capital balance with the broker, उनके पास अगर कोई deposit पड़ा है, if it is not squared off, if they are having something that you can report in your balance sheet. Yeah. Yes. If that is the only business, only then. Net loss. Again, I will say that you are required to get your accounts audited only if you breach the limit given under section 44AB. If your turnover is exceeding 1 crore and if there is a loss, yes, you are required to get your accounts audited. If the turnover is up to 1 crore, that is said upon 90 lakhs, and you are incurring losses, but you are maintaining your books of account. According to me, there is no requirement to do audit. In earlier is what you already opted, and this year you want to claim loss, then you are required to do audit. Is any other questions? Yes, sure, sir, sure. I'll take it. Yes, sir.
For relation, under not in visible NP, and we
It is possible because revision is allowed for any mistake or omission. That is an omission.
are aware of it.
I got a point, but you are not considered in this return. Practically, what I can suggest is if you know that there is an eligible and legal, deduction, you can make a claim of that in your ITR, even in the original ITR. Then again, obviously, it is going to get disallowed in 143.1. Then you again file it in the revised ITR, just so that you have a track that at least you have reported even that in the original ITR. Fair enough. So this is a set of query which is given by sir. He says that if there is a sale of rural agricultural land which is not considered as such as a capital asset itself, where should we report the amount which is received from that particular asset on sale of that land? In my opinion, whenever you are doing any agricultural activity, when you are doing any agricultural activity, selling the agricultural stuff, and you are earning income, that income is exempt under section 10. That is the income which is exempt under section 10, which is required to be reported in ITR under section 10. Whereas this is the case which is not exempt, it is not capital asset itself. So that is not falling under section 10 itself. If I go legally by the words of the act, according to me, it is not required to be reported in the ITR, this sale transaction, because it is not an exempt income. वो section 10 में exempt नहीं है. That is not the capital asset itself. Okay. So according to me, it will be fine if you are not reporting it anywhere in the ITR. But if you feel that yes, it is required to be reported, then in exempt income, they have line items of others. In that line of items of others, you can specify that this is amount is received on sale of rural agricultural land. And you can specify the amount just for the sake of reporting.
They are asking the sub-clause, and which clause?
No, you go to others.
I had previous, like a compensation of accident I have reported. And I have gone up to the tribunal for that matter. Ultimately, I have gone in various of that. Because I have declared that under exempted income, and the department is, you tell us which is the clause under which we can grant you exemption. So that is a capital receipt practically. So here also the one. Now the point is in AIF and TIF statement, this transaction is reflecting. The farmer has sold for 85 lakhs and that transaction is reflecting.
Perfect.
Being it is agricultural land, even 1% TDS is also not deducted by the other farmer
Correct.
who has purchased that land plot. So the point is that it is reflecting in AIS. So I have just read from your thing that being it is not taxable.
Perfect.
I may report that.
Absolutely. Absolutely.
Fine.
Dealing with derivatives, please.
Yes, it's a business activity. It is a business activity if you are not opting for 4480.
सर TIS और AIS का जो रिपोर्टिंग करना है वो रिटर्न फाइल करने के पहले करना चाहिए कि बाद में करना है?
Ideally before. Ideally real time.
अभी तो आगे तो टाइम ही नहीं मिलने वाला है. 4 दिन में रिटर्न फाइल इसको देख के बैठे.
So just a minute, someone is just a minute.
Correct.
and TDS is deducted.
Okay. 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 Sir, I have myself encountered this case in the Bombay High Court. It was our own call. The reported judgment of bullet train just came 1 year back. In the same thing had happened, that under Section 96 of the RFTLR Act, the compensation received from that particular bullet train company, that is a government company, unse humko compensation mila for acquisition of land. Okay, and that was exempt from any kind of income tax under Section 96 of the RFTLR Act, of that particular land law act. However, that particular company had deducted TDS, even though they are not required to deduct TDS. Because of that, it was reflected in 26 years, and because when I file my return, obviously it is going to, create a trouble for me. So I had directly filed a writ petition before the Bombay High Court, okay, stating that this government company has done this, which is wrong. High Court had admitted our petition, and they are told that this is not subject to tax. They should not have, deducted tax on it. They should reverse that. So all these things, remedies are there, but it is out of the line of the ITR. You have to go to 264, you have to go through the appeals, you have to go through the writ remedy. Exactly same case what you say. Bullet, if you read the judgment, Seema Patel is the name of the judgment. Seema Patel versus IT department. Yes. It is, they are distributing for what purpose?
It is a refund of funds. What way? It is a refund of fund. It is your
I think I will go by the concept of mutuality. If it is my own fund which is coming back to me, then principle of mutuality will apply. If it is something which is earned by the society and then it is distributed, then it may be subject to taxation. That is taxable in the hands of society, no, sir? Then that chances are there, it may be taxable. Then no. It will be tax in the hands of society itself. No, if it is received in the hands of society. Subsequent distribution after the tax payment, you can do anything.
Society has to earmark that it is a refund of sinking fund, refund of reserve fund,
Correct.
refund of repair fund.
Correct.
Under that circumstances, only it will be treated as a member
Yeah.
contribution.
Yes.
If they are saying that it is an income distribution, then it is taxable in the hand of.
Correct. It's a case specific thing. Yes.
I have debtors as of 31st of March. And debtors are valued as per the foreign debtors. Foreign debtors have value as of 31st of March. And because of that, they are increased by income. And the
Fluctuation, yeah.
Now that is liable for advance. Applicable on that?
No, sir. There is no exemption given for that.
Is valid.
Correct.
Because that rate I cannot accept.
I got it. Yes, sir. There is no exception given. You can fight it that 234 is not applicable for some reason. I'll say that there is no exception given for that category.
So in that particular case, it's taxable in the hands of the society, and society is giving a certificate to the member. There is the question of again paying.
No. Yeah, that is resolved, sir. That is resolved. Okay. Any other sir question? Yes, sir. Sir, someone is asking.
Sunday, if I say Sunday being the last day, so that exemption under general rules was earlier there.
Sir, there is a specific FAQ of the CBDT on this. It says that for e-filing, that General Procedure Act will not apply. Payment of tax, also, everything is online, so I completely said no. CBDT circular of 1992 specifically provided that if the office is closed on Sunday, you can file it on the next day. But now under the e-filing, they have specifically denied. Sir, please. Okay. Advisable if the party himself revise the TDS statement. Otherwise, you can do here also. Entire amount, yes. But advisable that they revise the statement. Yeah. I think. Yes.
So in the
December.
Correct.
But how about the income of that quarter for 22-20?
Yeah, so sir, this is a reporting schedule FA. It has nothing to do with your income. Income आपका जैसे accrual basis पे आ रहा है, as per the computation you have to do it. Here there is only reporting of what incomes you have earned and what asset you hold in a foreign country. That's it. There's nothing to correlate with them.
So the person, the seller is not deducted, now the buyer. What does it? Will he do it? Can he, or is it advisable for him to take some initiative or no?
Sir, they can revise the statement, no, anytime.
The amount at stake is too big. So what I am worried. The seller is not deducted.
Okay, sir, we can take up this query in person. Okay. Fair enough. Thank you so much for the patient hearing. It was
It is said by Giorgio Armani, to create something exceptional, your mind must be relentlessly focused on the smallest details. So I think Shashank has taken the smallest details which are required to file this year's AY 2023-24 returns. And I think we'll be doing it very seamlessly now. So thank you, Shashank. On behalf of JB Nagar Study Circle, I thank you and I request you all to please carry along with us. People they don't know. So बहुत question रहा है. So ऐसा ले लो तो फिर वो एक खत्म हो जाएगा.
I don't feel that the detail of that donation I have made, but I have not got the receipt. So can that be validated slide?